All right, so we've gone through the most important section in terms of capital budgeting. The rest that we have now, in terms of content, it's all like little parts of the big picture. Okay, so we spend time painting this massive picture of what a business is required to do in terms of capital budgeting. They need to take their limited resources, they need to pick and choose the best projects based on the actual future cash flows that have been discounted back in time. All right, so just before the break, we spoke about the importance of adjusting our measures for risk. One of the things that they do discuss in a lot of detail is this idea of the capital asset pricing model. You've already looked at this in FIN3601, that was part of the content. That module also uses the same textbook actually, and you would have covered this capital asset pricing model. Just to simplify the theory, just so you have a better understanding of what this deals with, if you're looking at CAPM, okay, CAPM is just a relationship between risk and return. That's it. Obviously, this relationship is linear. Okay, it's going to be upward sloping, and the formula is derived from this graph. Okay, this graph talks about a few important things. The first thing is this RF. Okay, what is RF standing for? It's risk-free. Okay, so when you're looking at the capital asset pricing model, right, this is a very common finance and investment term or theory that speaks to a very important concept, which is this concept of risk and reward. Okay, if you're a manager and you're deciding on where you're going to be investing your hard-earned capital in the business, you need to make sure that those decisions that you make have the best possible return on investment. Okay, and the only way we can establish whether we are adequately getting compensated for our reward, for the risk that we're taking in terms of the reward, we need to make sure that we've calculated this required return. Okay, so just some theory here regarding CAPM. CAPM uses market risk as the measure for the risk that's inherent in the market. So when you take on more risk, you would expect a higher return. Right, so if you look at this graph, the RF is your risk-free. Risk-free in finance and investment, any textbook that talks to risk-free, risk-free is basically the return or the reward that you would get without having to take unnecessary risk. The simple example I can give you is if you save money in a bank account. Right, we don't expect banks to go bankrupt. We don't expect banks to fail. Right, they can, but they don't often fail. And if they do fail, it's probably because of greed. It could be problems with certain banking products. For example, in 2008, when we had the banking crisis, Lehman Brothers failed. And then more recently, if you've been following the news, Silicon Valley Bank, SVB, they also failed. Right, but if you're looking at South African banks, our major banks, not the mutual bank, not the VBS, that's a whole separate consideration, but our proper commercial banks, okay, retail, commercial, investment banks, those big banks. Our banks in South Africa are extremely heavily regulated, and they have very good rules and policies in place. So our banks are actually very good in terms of regulation, and we wouldn't expect any of our banks to go bankrupt. And this is basically what risk-free is relating to. Right, so when you're reading any question, if they talk about risk-free or if they talk about interest rates, you need to assume that that would be your capital asset pricing model, but the base for that model. Right, so risk-free could be like the repo rate or the prime rate, depending on what you're looking at doing, if you're saving or investing or borrowing, depending. So when you're looking at risk-free, that's the starting point. Okay, obviously, at that origin of the X and Y intercept, there's no risk, there's zero risk. So risk-free is what you're compensated for not taking on any additional risk. So remember we spoke earlier today, we said capital budgeting is taking money and investing it responsibly, choosing a project, investment, business, asset, whatever it is, and we're hoping that that asset is going to generate future income. Okay, so we're going to improve our business by purchasing new equipment or upgrading the machinery, whatever it is. We need to look at the risk-free and we need to ask ourselves, if I leave that money in the bank, it's going to earn interest. that's risk-free. I'm going to get a return on investment just by leaving that money in the bank. If I'm going to be buying an asset, starting a business, buying or improving the infrastructure in the business, is that going to add more value to the business? And this is what this line looks at. Okay, it's called a security market line because generally speaking, you would also apply this in investments, and you'd also look at the market in terms of what you expect to receive on an asset that you're investing in, be it equity or any other asset. Beta or beta is the measure for risk, right? So at 1, that's looking at market risk, right? And that's why this 1 is important, because then you get this market risk premium, which is what is described here in the formula, right? So this part of the equation, just to highlight it, is the market risk premium. That's basically saying, if I'm going to be taking hard-earned capital from the business and I'm going to be buying or expanding, I need to make sure that it justifies that risk, right? So the market risk premium is the beta times the difference between the market premium, the market return, and the risk-free, which is the premium. Okay, that's the additional compensation. Okay, so the required rate of return is what CAPM is actually solving for, right? So this is just theory that you should be familiar with, because when you're looking at different questions, sometimes they talk about the cost of capital. Sometimes they talk about the required rate of return. Sometimes they talk about a CAPM return. Sometimes they talk about an interest rate, right? Whatever rate they're referring to, it's generally relating to the cost. Okay, remember, because we're looking at finance, because we're looking at financial management, the focus is on the costing, okay, what we're doing internally. We're not looking at what's happening externally, right? If we're looking at investments, then it's a bit different. Okay, then you're looking more at the return, so what you're getting rather than what you're like spending, right? So from a contextual point of view, in this module, just remember that CAPM talks to the costing side of things, right? Which is the weighted average cost of capital, right? And it's quite an easy calculation because you're just looking at weighting, so how much debt, how much equity, right? But you need to understand these basics because CAPM is the measure that you're going to be using to help you calculate the weighted average cost of capital, right? So if you don't know this, or if you've forgotten this from your previous module, FIN3601, you can't do 3701. Okay, so this is just a recap, just to note how important capital asset pricing model is and what the equation actually stands for. Okay, it's the required rate of return, which is just your risk-free, plus this idea of a market risk premium, and that's it. Right, that's basically CAPM. Right, what are we going to be, or where are we going to be applying this? Well, we spoke about it this whole morning, capital budgeting. Right, we're continuing with this concept, but we're adding to the basics. Okay, we're looking at the actual accept and reject criteria. Right, so remember that line that we spoke about. Okay, the capital asset pricing model gives us an expectation. Okay, it considers risk and it considers return. So when we're looking at CAPM, what's important here is we accept, okay, when the internal rate of return is greater than the capital asset pricing model. Right, we just spoke about IRR a few minutes ago. IRR, we said, was the internal rate of return that a particular project or investment or asset is going to provide us with. We need to compare that to something like CAPM, or we could compare that to the weighted average cost of capital. So it can be CAPM in terms of required return, so asterisk RR, required return, or it could be the weighted average cost of capital, WACC. Right, so it all depends on what type of question you've been given. Right, but you accept when IRR is greater, because that tells you that the project is giving you a much, much higher return than you would if you had to leave money sitting in a bank, or if you had to accept any other project that has a similar level of risk, or if I had to raise capital, how much is it going to cost me to raise capital? So long as I can get more from the project than it costs me to raise capital in the market, then obviously you would accept the project. Okay, if it was the opposite, then we would reject. Okay, you would reject if IRR is less than CAPM, okay, the required return, or less than the weighted average cost of capital. right? Because then it doesn't make any sense to go raise capital in the market. Right? Remember, money has a price. If you're going to take out a loan, the bank is going to want interest. If you're going to sell shares to your shareholders, they're going to want a dividend. Okay, they're going to want some sort of return on investment. Okay, that's the cost of equity. So you have two costs. You have cost of debt and you have cost of equity. And that's what you need to look at here. And this is how it links to what you'll see later. Cost of debt and equity is important for the weighted average cost of equity, or cost of capital, because you've got the two. You've got equity and you've got debt. Both make up the cost of capital. Right, so just think about money. Where are you going to get the money? Before the break, we said capital budgeting is the projects that we invest in. Budgeting, okay, where are you going to allocate those funds? Okay, that's basically what a budget is, right? It's allocation of money, funds. Here, we're looking at, well, if I'm going to allocate those funds, I need the funding. I need to raise that capital. And that's what capital, or CAPM, that is what the capital asset pricing model is referring to. All right, so that's important to note. You'll see this later in other sections. Right, and there's just a note here regarding the RADR. We spoke about that at the end. Just remember, this is something that I have seen. They've asked this in some questions that relate to capital budgeting. But remember, they're never going to ask you to work out this rate if they've asked you to do all the calculations for the initial investment, the operating cash flow, or the TCF, okay, terminal cash flow. Right, if they've given you that part to calculate, then when you get to this part, they'll give you the rate. But sometimes, in some of the past papers, I've seen them give students multiple rates. So you have one rate, they could have given you like a cost of capital, but they also give you an RADR, which is a risk-adjusted discount rate. Okay, so when you do your capital budgeting decision-making, just remember, always use all the rates provided. Okay, what do I mean by that? Well, remember we said if you're adjusting the rate, it's going to make accepting or rejecting the project more difficult, especially if you've increased the rate. Right, so obviously if there's low risk, there's a low rate. Okay, the higher the risk, the higher the rate. Because if I discount future cash flows back in time, and I'm using a bigger interest rate, a bigger I, your net present value, your NPV is going to be smaller. Okay, so just a note, look out for it. It might or might not come up. Okay, but just note for exams or for long questions. Okay, if the question's out of 10, 20, 30 marks, however big the question is, always look out for that and then just make a little note. Always talk about it. Talk about the theory. Tell the examiner that you've noted that in this scenario, yes, you have a cost of capital, but you know risk is a problem. It's a consideration. So in order to refine the model, we're also going to take that discount rate into consideration. Right, so then you would say, well, based on cost of capital, okay, NPV is, and then you can calculate it. And also state, using the risk-adjusted discount rate, NPV is, and then write that down. Right, if both of those amounts are positive, then your conclusion when you do the recommendation or when you answer the question will be, yes, I'm going to accept the project. Okay, so just something to consider. It can come up in an exam. I have seen it in one or two past paper questions where they have given multiple rates. They don't just give you one, they give you multiple rates. But you'll never have to calculate the rate, you just have to apply it to the capital budgeting decision. Right, so just something to look out for when you're doing practical questions. Right, and this was the note about that unequal life situation. Right, this I also have seen. Okay, but remember earlier we spoke about that equivalent annual annuity, the EAA, from one of the slides in the time value of money. This is the first example where I'm actually showing you how to use it. Right, so you can see project X and project Y. Obviously, there are two different investments. I can go with X or I can go with Y. X, 3 years, Y, 6 years. Right, if you work out NPV for both, okay, because you've done this, I don't want to waste time and ask you to do it. I'm just going to show you the answers. Okay, those are the answers. Project X, if you do the calculation for NPV, you're going to get 112,772. If you work out the NPV for project Y, you're going to get 190,133. If you look at both of them, they're both positive. So you'd be inclined to accept X and Y. If you've got enough capital, again, this speaks to that capital rationing that we spoke about earlier. Let's assume the company only had R1 million. Right, if you only have R1 million, even if they are independent projects, I still can't choose both because I have R1 million. I have to make a decision. Am I going to go with X or am I going to go with Y? Because I can't afford to take them both. Right, you can't. Okay, if you've only got R1 million, you need to make a decision. I'm going to invest in project X or I'm going to invest in project Y. So see, that's something that you could also talk about if the project or if the scenario talks about these projects with capital rationing as being a focal point. Right, as I said, sometimes they can give you that information in the scenario. Sometimes they don't. Then you can just elaborate and you can say, well, if they're independent projects, they're both positive in terms of NPV, so you would want to accept both of them. Right, but is it fair to compare X and Y? Definitely not, because project Y has twice as many years, okay, in terms of time, to generate more returns. Right, so obviously project Y potentially could generate more, but if we're looking at each project individually, which is the better project? And remember, if capital rationing applies here, I can't choose X and Y. I have to choose X or Y because I'm limited by the R1 million. Okay, or if they were mutually exclusive, if, for example, if I accept X, then Y will no longer exist. I can't choose both, I have to choose one or the other. That can also be a potential question. Right, so read the question carefully, look for things like that. Does capital rationing apply? Yes or no? Is there risk? Yes or no? And then the next thing would be, well, are these independent or mutually exclusive projects? Can I accept more than one, or can I only accept one? And if I choose one over the other, does the one eliminate the other? Then, if you had that as a scenario, then you would definitely, without fail, have to calculate what the equivalent annual annuity is, right? And all I mentioned here, okay, NPV will become your PV, right? So you should be okay with time value of money. You should all be able to put your NPV, so these answers, in on your calculator as a present value, and then literally solve for your PMT, but using the time frame. So for X, I'm going to have 3 years. For Y, I'm going to have 6 years. And I'm going to annualize these amounts to see how much does that project actually produce. Right, and if you do that, okay, I'm just going to reveal the answers. You're going to get project X, 45,000, project Y, 43,000. Right, so you can see if we're comparing apples with apples, if we're looking at them on an annual basis, every year project X actually does better than project Y. Okay, overall project Y does do better, but we need 6 years to get that higher NPV. Project X, in 3 years, we've already generated that amount of value. Right, so if we had a choice between X and Y, ultimately X would be better. Right, if I can choose project X twice, I would choose project X twice. I would start the project, run it for 3 years, stop, and then start the project again, run it for another 3 years, because then I'm going to be generating more value rather than having one project that runs for the full 6 years. Okay, so again, just refinements in capital budgeting, things you need to be aware of and things you need to consider when looking at those long questions, okay, those big scenarios. Okay, so remember capital budgeting, remember the importance in terms of those different cash flows, so INV, OCF, and TCF, and then also remember that those rates can be adjusted based on risk, or you could be using CAPM. Okay, you need to compare that to your IRR, and you always need to look at value. You always need to look at the NPV, okay, the net present value. Okay, NPV, we spoke about it earlier, is the best measure of value. Okay, if you don't have NPV, you definitely have to calculate it. Okay, in all capital budgeting questions, NPV is a given, right? You have to calculate it. IRR, I would also calculate, especially if they give you other rates. Payback period, if you want to calculate, you can. And then these annual rates only if the projects have different lifespans. Okay, different lives. All right, and that's basically it in terms of refinements. Are we okay with refinements? Are we happy? This is literally just a wrap-up, just highlighting how important this is. Just remember, value is key, and that's why NPV is the preferred measure. Okay. Okay with risk and refinements?
Yeah.
Yes.
Great. Okay, so now we're jumping a little bit in terms of focus. Right at the beginning, okay, we looked at this. Okay, long-term investment decisions. Right, we're moving away from that now. We've covered all of those topics, okay? But remember, these topics relate to capital budgeting because this is the financing part of the discussion. Right, so now we know where we're going to be allocating our money because we've budgeted. Now we need to look at where we're going to get that money. Right, that money is going to be raised either through debt or equity. Right, so over the next few chapters, okay, or study units, the focus is just on that, financing. Forget about investments now, okay, forget about the capital budgeting. That's its own question. It'll be separate, it'll have its own rates, etc. Okay, if you do get a separate question specifically asking you about financing, then they're going to ask you to calculate these amounts. Okay, you won't have a combined question. I've never seen that in all the years that I've been helping students. I've never seen a question where they've asked you to do both in one. Okay, obviously in the real world you would have to do both, but from an exam point of view, you don't. Okay, it'll be one or the other. Right, so spot it, spot the cash flow, spot the initial investment, TCF and OCF. If it's that, then you'll get lots of mark for doing all those workings. And then other questions, shorter questions. When I say shorter, these could still be maybe about a 10 mark, maybe a 15 mark. They won't be as long as those. Okay, these are generally the longest, okay, the capital budgeting, because of the amount of workings you have to do. Right, these ones are generally a bit smaller, maybe 10, 15 marks plus minus. Okay, and they're a bit easier because they're in isolation. They're separate. They don't link in terms of like the decision making. It's separate. Okay, this is looking at the financing, raising the capital. Okay, so we need to look at that. That's the next part. Okay, so that's the focus, just to give you more context. Okay, so we're looking at study unit 4. The first, cost of capital. A lot of this is time value of money. So I'm glad that all of you have the basic TVM, okay, the skills necessary to do time value of money. Right, you need present value, future value, you need I, you need N, and you need PMT. Okay, remember in time value of money, you've got those 5 variables. When looking at this topic, you've got 2 key considerations, debt, okay, and then later you've got equity. Okay, preference shares is somewhere in between. Okay, it's shares, so it's equity, but it's not quite equity because those preference shares, you have to pay out a dividend. Okay, there's a payout that has to be made. It's almost like an obligation, right? So debt would be a liability if you're thinking accounting. Okay, ordinary shares would be equity. Okay, equity would be ownership of the company. All right, so the first few slides is purely theory. I'm not going to spend too much time on this. I'm just going to highlight some of the important points. When you hear the word cost of capital, when you see the word cost of capital in an exam, you need to think, okay, every company is unique, every company is different, okay? Every company will raise capital using a certain amount of debt and a certain amount of equity. It's their choice, right? Some companies are more aggressive, they'll use more debt. Some companies are more conservative, they'll use more equity. But all companies will have a mixture of the two, right? And then we will look at that. Okay, that's called the weighted average cost of capital when you're looking at both. Right now, the word cost of capital is referring to one or the other. Because remember, both are forms of capital. So you can have debt as a form of capital. You can have equity as a form of capital. So this word cost of capital, very generic word, very, very general. They're just stating, how much does money cost? If I had to raise capital, how much money am I going to spend financing the debts, right, or paying the shareholders? Right, and that's what you need to remember here. Okay, the recommended criteria, just to reveal, Okay, always, always, always NPV greater than 0, so value is being created. And then this one is the important one. Okay, we just spoke about it earlier. IRR is what we get from the project. We need to compare that to how much the project costs. Okay, cost versus benefit, basically, if you're keeping it really, really, really simple. All right, so if I raise money, how much is it going to cost us? And if I implement that money, if I use that money in a project, investment, asset, whatever, how much do I generate in terms of internal rate of return? Okay, do you see how the two link? Okay, what we did before the break links to what we were doing after, but the after is looking at that. Okay, we're looking at the financing, the raising of capital. Okay, and that's what we need to measure, and that's what we need to calculate. All right, so the first bit is just looking at risk. There will always be risk in any environment. There will be risk. Sometimes it could be business risk, sometimes it could be financial risk. What we have to always consider is debts. Okay, earlier we spoke about debts. Okay, we said debt is using other people's money. Okay, if I'm using debt, is it good to use other people's money? Well, the answer is yes, because debt is after tax. If you've studied accounting, okay, you know that interest is an expense, right? And you also know that interest is deductible. All right, it's a business expense. All right, so the nice thing about debt is when I pay interest, that interest that I pay is, inverted commas, considered part of operations. It's deductible. Okay, when you looked at that accounting, remember we did OCF? Okay, that was that table that we drew up here. And we spoke about before interest and tax. Okay, so interest is subtracted before we calculate our taxes. Right, and that's why we like interest. Okay, I didn't show interest here because it wasn't included. Interest was 0. If there was, then you would insert it. Okay, but this interest that we're talking about now, which is related to financing. Okay, that's why financing is so powerful. That's why, okay, not having money is not always a bad thing because you can raise capital. Right? Large companies, big businesses, everybody wants to give them money. Everybody wants to give them capital. And if they loan money, especially when money is cheap, inverted commas, so if you look at the world, when interest rates were at their lowest, everybody was taking out a loan. Right? That's why SVB and some of the banks in America are struggling because of the rising interest rates currently. Okay, money isn't as cheap as it was before. It used to be a lot cheaper. Maybe even as an individual. I'm sure all of you are aware of it. Think about the bond or the interest that you paid on your bond a few years ago compared to the interest you're paying on your bond today and how that has changed. Right, if you're using debt, always remember it's a good thing. Debt is good because you can claim a deduction. Debt helps us. It doesn't harm us. All right, so when we're looking at cost of capital, okay, in the WACC calculation, which you'll see later, always remember that debt is after tax, so you need to remove tax, always. Okay, so inverted commas, debt can be cheaper because of the write-off, because of the interest tax deduction that you can make use of. All right, so now let's look at targeted capital structure. Remember we said there's a balancing, like it's a choice. Okay, you decide how much debt you use, you decide how much equity you use. Here's a very simple example just to discuss it. Company A has costs of $1 million and has a life of 20 years. Okay, the calculated IRR is 14%. Right, so that's how much the project costs. Remember, that's looking at investing in the project. Okay, so I need R1 million to start this project. It's going to last 20 years. Okay, the IRR is 14%. Okay, that's how much I'm going to get from this project over the 20 years. If the cost of financing is 12% after tax, am I going to accept or reject? What do you think? Let's see if you know what the principles are. Accept or reject? Would you accept or reject this?
IRR is 14%.
And the cost
so
of
it's
capital
more
is
than
12?
the cost of capital.
So would you accept or reject?
Accept.
Then we'll accept.
Definitely. Okay, just think about it logically, simple terms. Okay, getting money from a bank that's going to cost us 12%, and remember, that's cost of financing. It could have come from debt or equity, doesn't matter. But we're just using this as an example, right? If I'm going to raise money and it's going to cost me 12% after tax, is that worthwhile? Yes. I can make an extra 2%, okay, from this project. Right, so even though R1,000,000 might be a lot or little, depending on how big or small the company is, if we're looking at this cost of financing, it makes sense to take out more debt. It makes sense to sell more equity, more shares, to raise more capital. Right, and businesses will constantly raise capital until you have the opposite. For example, what happens now if this company wants 2 million, the internal rate of return is 16, and the financing cost is 18? Accept or reject?
Reject.
Definitely. Okay, at some point, money gets too expensive. At some point, even as individuals, even if you think about it logically, we go to our bank, we take out a loan. The mortgage, the home loan, we get the cheapest credit. Okay, you pay the lowest interest rates on your bond. Okay, then if we can't access the bond, then we're going to start looking at assets. Then we're going to take out car finance. You'll pay a little bit higher interest rate on that. Right, then you're going to take out a loan. You'll pay slightly higher interest rate on that. Right, if you're taking out more and more and more loans, eventually the bank's going to say, sorry, you've reached your limits. We cannot extend more credit to you as the customer. What can you still do? You can go to the loan sharks. Okay, people that are unregulated, and you can take out more debt from them. But at some point, it gets so expensive. All right, so in this scenario, this financing cost, it's so expensive, it doesn't make any sense. Why are we going to raise more capital? Even though this project is going to give us 16%, money is too expensive. We can't find enough money to accept more projects. Right, and you will see this in one of the examples. If you go look at some of those past papers, you'll see one of those past paper questions talk about the increasing projects, accepting more and more projects. And you'll see at some point your weighted average cost of capital, okay, your cost of financing, it gets too high and it exceeds your IRR. Right, and I've got a diagram later, but let me show it to you now quickly. Okay, it's the leverage. Okay, that's a bit too late. Let me see. Yeah. Right, I'll rather wait, otherwise I'm jumping too far ahead. But yeah, if cost of financing gets too high, if it gets too much, you're never, ever, ever going to raise more capital. It doesn't make any sense, even if the rate seems very attractive. 16% seems pretty good, but raising capital, way too expensive. It's going to cost me 18%. I'm going to stop accepting projects. Okay, we've reached the limits. Right, so sources of capital, you've got two, we just spoke about them. There are 4 basic sources of funding, just to reveal the answer here. Okay, long-term debt, you will see all of these in a question related to weighted average cost of capital. Okay, it's part of the WACC calculation. Just a note, every time you see a different form of financing, you have to do a separate calculation. Right, and I've shown all of these in separate slides just after this. Okay, so we're going to be looking at each and every one of these. Long-term debts, preference shares, ordinary shares, retained earnings. Okay, with retained earnings, this is a special one. Okay, there's a little note here that talks to academic theory. So in the past, there was some research conducted in terms of cost of financing, and there was a question asked about this. Should you allocate or assign a cost of retained earnings? Because that's earnings that you've kept from previous years. Right, so technically that money is in the business. You haven't had to raise more capital. If you've had a good year and you've generated a profit, you save some of it. Okay, even as an individual, you earn money, you save some of it, you earn money, you save some of it. Okay, at the end of a certain period of time, maybe after 5, 10, 20 years, you've got a substantial amount of savings or retained earnings. Right, would you say that there's a cost attached to that? Well, you could, because if you didn't have the savings, you would have to go take out a loan or you'd have to raise capital. So there could be a cost. Right, technically, there is no cost because it's profit that the company has set aside and they can use that in future years. That's why during the pandemic, many companies were able to survive. Some didn't because they ran out of retained earnings. They ran out of cash. They ran out of savings. Those companies that continue to operate now, that got through the crisis, that got through the recession, that got through the problems in terms of inflation, and things are still ongoing, even like with load shedding now, these things will always be around, okay? It's does the business or can the business get access to funding, right? As long as you can get access to funding, you will continue to operate. You're not going to go bankrupt. And that's why we need to look at these four. Okay, so remember them. Look at them when you're doing a weighted average cost of capital calculation. Right, so the first one, cost of debt. There's number one, okay? Remember we said debt is good. Why? Because it's after tax. Interest is tax deductible. Okay, there's the note in your slide. Okay, net proceeds is how much I get after I've issued the bonds. Okay, so when you sell bonds, this is something you covered in FIN3701, the previous module. It's exactly the same here. Okay, so it's revision. There's nothing new. Okay, in the previous module, before you did this one, you did cost of long-term debt. You had to calculate the cost of bonds. When you calculated the cost of bonds, you had to work out the present value of the future cash flow. Right, so you had to look at the bond, you had to look at the par or face value. What variable is the par value representing? FV, future value. Then you've got 10% coupon interest. What does that represent? That's the payment. Okay, because remember, if you issue a bond, that bond needs to pay interest. Every single month you have to pay interest. Every single month there's an obligation to pay interest. Right, so that's the payment. So the coupon is the payment. The future value is the par or face value. Right, and you'll see examples later. So I'm just highlighting it. The yield is the I. Right, the only ones we haven't looked at yet is the N, which is obvious, the time. And then the PV is the current amount. Okay, this net proceeds, what you actually get, right, when you issue a bond. Okay, remember these are big businesses. We're talking corporates. Right, bonds, we think of a bond as a liability, okay, because we're individuals. Okay, you have a bond, you have to pay it off. But a company can actually issue a bond. They create these bonds. They create these financial assets. Investment banks help them with that, but you're creating these products. Okay, you can invest in a bond. That's different. Right, but a bond is just that, it's a product. Okay, when you have a product, there are certain terms and conditions. These are the terms and conditions. How long is the bond? How much do you pay on the bond? What is the interest that's paid as the coupon, the repayment? And then you've got the future value, okay, the face or par value, and then you've got the current PV, which is the present value. Right, so we'll see that. We'll test your workings just now. Here's one example. Okay, discounting future cash flows back in time. Right, remember, we're calculating the bond's cost of capital. What is cost of capital? It's the rate, it's the I. Okay, the interest rates. Let me write rate rather, that looks like an L, I. Okay, rates. Okay, so on your calculator, let's see if you know your time value of money. What is my FV here in this question?
1,000 rand.
Yes, the par value is the FV. Good. Okay, what else do you have in the question? The PV, that's the current. Okay, I don't know if you were taught this. You should have realized it. You have to make one positive and one negative, hey? Otherwise, the calculator gets confused. Inflows and outflows. Okay, because we're raising capital, our PV will assume is plus and our FV will assume is minus. Okay, because you have to pay the bond back at some point. Okay, that par value is paid at a later stage. Okay, so this is the amount of money you raise today. Okay, that's the amount of money you get from the bond. The 9% coupon, remember the coupon is calculated on the par value. So 9% of 1,000 is 90. 90 is the payment. And then obviously 20 years, okay, which is the N. Right, so on your calculators, let's just make sure you can all get the same answer. This is just to test your calculator skills in terms of simple time value of money. If you put in FV, PMT, N, and PV. Right, if I made FV minus, then I'm going to have to make PV minus. Both have to be negative if it's financing. Both of those have to be the same sign. Okay, so I'm just putting that in, or if you make them both positive, okay, then your other one needs to be negative. Does that make sense? Okay, you have to have one negative and one positive. All right, so either make FV and PV positive or negative. Okay, and then make the FV the opposite, the PV the opposite. Okay, negative PV. Okay, yeah, so that needs to relate. Okay, so you can decide which is better for you, but yeah, just be careful with that. The FV and the PMT, those two, the FV and the PMT must be the same. So either both negative or both positive. And then the PV will be the opposite. Okay, what rate do you get? If you solve for I, what do you get?
9.45.
Yes.
Yes.
Okay, both agreeing. Well done. Okay, that's correct. Good. All right, so that is the rate. Remember, what did we just calculate? We calculate the bonds cost of capital. So, coming back to weighted average cost of capital, you'll see all of them grouped together eventually. If I'm looking at one source of capital, remember earlier we had the diagram? Okay, we saw debt and equity. Okay, I could have added a whole bunch of other arrows here. Okay, there could have been more arrows here. Multiple arrows. Under debt, there will be multiple arrows. Under equity, multiple arrows. Okay, but we're just keeping it simple. Your content, your textbook, your exam is going to give you these. Okay, long-term debt, pref shares, ordinary shares, retained earnings. Just be careful with the debt. Sometimes they talk about debentures. Sometimes they talk about bonds. It's still debt. It's still long-term. Okay, so, but they're separate. They're different financial instruments. All right, so now that you know how to do that, okay, there's a few other examples here. Just for the sake of time, I'm just going to give you the answers. Maybe just take note or jot them down, and you can do these workings when you have more time. Very similar, we're working out bonds, cost of capital. So in other words, we're working out the rates. Right, the answer for 2 is 10.27, and the answer for 3 is 13.37. Okay, I'm just noting that here. When you have more time, please try do these additional questions, and you can practice and see if you can get the right cost of debt. Remember, all we're looking at is calculating cost of debt. Right, but let me ask you, this 9.45 that you calculated here, is this actually what debt is going to cost the business? Is this what we're actually going to pay or incur?
No.
Why not?
We haven't considered the equity.
You haven't considered the tax. Okay, there's the answer. Okay, right, so remember, with cost of debt, in any calculation, when they ask you to do any calculation that talks about cost of equity, cost of debt, cost of anything, debentures, cost of bonds, cost of, it doesn't matter. Okay, remember, the focus is financing. Where are we getting our money? Okay, if money is coming from bonds, it has a cost. If money is coming from debentures, it has a cost. If money comes from any form of loan, it has a cost. That loan, that debenture, that bond is considered debt. This is something you have to always show. And you will always get marks for this. Right, so don't lose the easy marks. Whatever your cost is. Here the cost was 9.45. All we have to do is literally take this 9.45%, okay, and literally plug it in here, okay, and then less the tax rate. If the tax rate is 27%, okay, that's the current corporate tax rate in South Africa, then you would multiply that, right, and then you would get a rate that would be less than that. Okay, so if you take your calculator, you'll see cost of debt is actually less. 9.452 times 0.73 gives you 6.89996%. Okay, this is what cost of debt actually costs us. Okay, actual cost because it's after tax. Right, always remember to show that as part of your answer in your write-up, okay, in your solution. Cost of debt, remember, interest, tax deductible. All right, interest is tax deductible. It's a business expense. You take it off your earnings, and then you work out after tax. Okay, so the cost of debt is actually less than what you've calculated it to be. Okay, that's very important from an exam point of view. Don't forget. So
you're basically going back your cost of debt into an ops expense, doing this formula.
To say that again, I didn't get that. Just say
so your cost of debt basically goes back into your operations expense once you do this less tax.
Yes, yeah. So you'll remember, yeah, the cost of debt, your interest is taken into consideration as part of operations, yeah, because interest is a normal expense that's deducted.
Okay, cool.
Yeah, good. Okay, that's the first one. Number one, complete. Number two, pref shares. Okay, the nice thing about pref shares, it's quasi-debt. That's the word they used to describe it. That was actually from the textbook. Okay, they talk about quasi because it's similar to debt, but it's not quite debt because it's actually shares. It's actually equity. Okay, but the reason why they consider it debt, not equity, is because it has to be paid out. Okay, just remember, dividends are paid after tax. So please don't take out tax again. That would be incorrect. Okay, so with cost of pref shares, right, because it's after tax, as long as you have the dividends, all you're going to do is take the dividend and divide it by the net proceeds from the sale. Okay, that's the formula. Okay, it's very similar to a perpetuity. Again, I don't know if you've done the DSC 1630. That's a very good module if you want to do lots of time value of money. Okay, they call it a perpetuity because it never ends. Okay, a perpetuity means it will be paid out forever and ever. A preference share dividend always pays out. Okay, those preference dividends have to pay out. Okay, it's the type of product it is. All right, so the cost of pref shares, there's your formula. Okay, that's the formula you would use when answering a question like this. All right, so let's just do one example. The others, I'll just give you the answers to. Let's try do this one. Okay, here's the example. We're looking at a company that has a 10% pref share. Okay, the cost of selling the pref share is 5 Rand per share, and the analysts expect the shares to be sold for 87. So if we had to calculate the cost of the preference share, what do we need to do? We need to write down this equation. Okay, so can you give me the dividend? How much is the dividend? Let's start with the dividend. How much is the dividend here?
R5.
No, 5 Rand is not the dividend. That's the cost of selling the share. Okay, that's the net proceeds. Remember, you're going to have to issue these shares. The commercial bank, the investment bank, they're going to have to issue these shares on your behalf, and they're going to want some sort of commission. Okay, so the cost that we've attached to this is 5 Rand. Okay, that's not the dividends. That's the cost of issuing the share. What is the dividends?
87?
87.
No, that's the price. It's 10% of 87. Okay, it's a 10% pref share. Remember, it's like debt. Okay, 10% is going to be paid out. So what is 10% of 87? 8 Rand 70. Okay, that's the dividend. There's the working here, the bottom. Okay, 8 Rand 70 is the dividend. The net proceeds, so going back that formula we had here, there's the net proceeds. Okay, how much capital are you going to raise? 87 minus 5, which is 82. Okay, so if you're looking at the cost of this particular financing, okay, the cost of pref shares would be 8 Rand 70 divided by 82, which is actually 10 Rand. Not 10 Rand, sorry, I said 10 Rand. 10.6%. Okay, and remember, this is another form of financing. It's a second form of financing. It's pref shares. It's a different form of financing. Make sense?
Yeah. So basically what your shares are being sold are the ordinary shares then.
No, these aren't ordinary shares. These are pref shares.
Yep.
Ordinary shares, that's a separate working. We'll get there just now.
Okay.
Okay.
I'm just confusing this 87 Rand.
Remember, we're looking at financing. From now until the end of today, we're all looking at financing. Things that relate to financing. Even leasing relates to financing. Everything we're looking at now is basically financing. Okay, where do we get money? How do we get money? And how much does that money cost us? Okay, so if we're looking at preference shares, it's going to cost us 10.6% because we have to pay a dividend, 8 Rand 70, and we're only getting the net proceeds. Right, so every share that we sell is going to bring in 82 Rand. Obviously, they can issue as many shares as they want. Okay, this is that's what companies do. They raise capital, they sell shares. Is that all right? Are we on the same page?
Yes.
Okay. All right. So you have a few other examples. Again, just to save some time, please just take note of the answers here. This one is 8.35%. Okay, that's the answer for this one, 8.35%. For example 2. Example 3, 15.66%. And the last example, example 4, 12.18%. Make sense?
Yes.
Okay. Okay, the third form of financing is this one. Cost of ordinary shares. Now we're looking at ordinary. Okay, so I heard the word earlier, ordinary. Here's ordinary shares. Be careful with this one. Okay, for ordinary shares, you have 3 different methods to calculate the cost of ordinary shares. An ordinary share is a share that we're issuing on the JSE, okay, to all shareholders, any shareholder. Okay, not preference shareholders, ordinary shareholders. Okay, these are ordinary shares. Right, so when you're looking specifically at ordinary shares, you have different options. You can use Gordon growth, you can use the capital asset pricing model, CAPM, or you can use the discounting of future dividends. Okay, those are the 3 different techniques. Okay, so you had debts, we broke that up into 2, you had bonds and you had pref shares. Okay, now you've got ordinary shares. Okay, under ordinary shares, just be careful, you've got 3 different techniques. Okay, these techniques help you to calculate the actual cost of equity. Okay, so those are the 3. So we're going to look at each one separately. The first one, Gordon growth. Right, this is the Gordon growth model. Okay, Gordon growth, the dividend, D1, which is the first dividend that you've paid, divided by the share price, which is P0, and then you add the growth. Okay, that's the formula. All right, if you're looking at the present value, okay, or the price, you can switch it around, then it'll be dividends, okay, the dividend 1, D1, divided by the R, which is the rate, minus the G, the growth. Okay, that's derived from the Gordon growth. Right, so that's the rate that you need. You can just write it down as is. If you've done I and V, you should be familiar with that one because they look at pricing equity rather than looking at cost of capital. Okay, it's just different perspective. Here we look at cost. There we look at return. Okay, so here, this is important. That's the formula that you need. That's the one that's important. Okay, take the dividend, divide it by the price, and then add the growth, if it's Gordon growth. Okay, so here's an example, one for you to try. Okay, we've got a company, they have a share price of 50 Rand. The firm expects to pay a dividend of 4 Rand in the next year. Dividends are expected to grow at 5% per year. Calculate the cost of equity. Okay, I think I've got a nice working for this one. Yeah, I do. Okay, there we go. What is the dividends? 4 Rand. Okay, just think about it logically. If you're going to sell shares, you're going to have to pay a dividend. That dividend is the inverted commas, the cost. Okay, so we've got the cost here, 4, divided by the price, 50, and then we're going to add the growth. Remember, mathematics, division before addition, okay? Divide first, then add. Okay, so once you've divided, then you add, you'll get 13%. Right, happy with Gordon growth?
Yes.
Okay, so Gordon growth is just a formula. That's the equation. Right, if they talk about share prices, dividends, growth, make sure you write down that formula and you use that equation. Okay, it's just about knowing when to use what. Okay, so when you're looking at cost of equity, okay, cost of equity, if I'm looking specifically at ordinary shares, I can calculate the cost of equity using the Gordon growth equation. Right, there's another example here. Just to give you the answer, it's 6.8%. Okay, very, very similar calculation. If you use the same formula, you'll get this answer, 6.8%. All right, so that's method number 1. Method number 2, or technique number 2, the one we spoke about earlier, but it's applied now to equity. Okay, CAPM is universal. It can be used in finance, it can be used in investments, it doesn't matter. Remember, it's about pricing. Okay, but remember, we're not pricing an asset here, we're looking at the return. Okay, so when you're looking at Gordon growth, you've got the required return, risk-free plus market premium. So here, let's look at an example. Here's one to look at. Company A, we've got an example of working out cost of ordinary shares. We just spoke about the different variables. Okay, remember, cost of ordinary shares, we need to calculate required rate of return. Right, if the company has a beta Remember, beta is the measure of risk, 1.5. The market risk-free is 7%. That could be like leaving money in a bank account or money markets. And the market return is 11%. Okay, if you had to calculate CAPM, remember that formula, required return, right? Risk-free plus the market premium. The market premium is calculated by using the beta or beta times the difference between your market return and the risk-free. Okay, you also get 13% here. All right, so we look at the cost of ordinary shares. Okay, so just remember when you're looking at financing, okay, you're looking at different sources of capital. If it's debt, we need to work out the amount, the percentage, okay, the cost. If I'm looking at equity, same thing applies. I need to work out the cost. Okay, how much does it cost? Right, here, based on CAPM, it's costing 13%. Okay, again, this is one more example here. Same working as before, but different variables. If you use this beta and the risk-free and the market return, you're going to get 17.8%. Okay, you'll see this one's a bit higher. Why is it higher? Beta, risk. Okay, it's a more risky company. Okay, so you would require a much higher return. Okay, it's a linear relationship. Return and risk. That's the capital asset pricing model. Right, it's linear, it's sloping upwards. Okay, so if you plug in all the values, you're going to get that answer. Okay, just to show answers. Right, next, last one. After the CAPM, okay, we've done the CAPM. Just remember, you can also discount future dividends back in time. It's also possible. Okay, we'll look at that. Just something else to consider. Which is the best method? Okay, if you've read through the textbook, this is what I was mentioning earlier. Is there a cost, inverted commas, is there a cost for retained earnings? Or would you attach zero? Let me ask you that question actually. On your retained earnings, would you attach zero to that cost? Would that be a prudent way to make decisions? What do you think?
Could you repeat the question?
Would you attach a cost to retained earnings? Do you think it's a good idea to attach a cost for that?
No, it's not good. It's not a good idea.
You don't think so? Okay, well, here's the opposite. If you don't attach a cost to your retained earnings, do you agree you're going to be accepting any project, right? Because
Yes.
your IRR will always be greater than your cost of capital.
Yes, true. Okay, yes. So you should attach a cost. Basically, it would be an opportunity cost then, type of.
It could be seen as like an opportunity cost, definitely. Yeah, because the retained earnings, you could be putting that somewhere else. You could even attach a cost of the risk-free. You could say, well, it's retained earnings, it's money sitting in the bank account anyway, right? So it might not have such a high cost as ordinary shares, but it's similar. Okay, so the textbook debates this, and they talk about retained earnings versus ordinary shares. If you have retained earnings, do I have to raise capital? The answer is no, you don't. If I need to sell shares, ordinary shares, do I need to, is there a cost in terms of selling those shares? Is there a cost?
Yes.
There always is. Okay, those banks, those investment banks, they're not going to sell your shares so you can raise money for your company without charging you a fee. Okay, there will always be flotation costs. All right, so the textbook talks about retained earnings, okay, as having a cost that's similar to ordinary shares. Again, I've seen questions in past papers where they have given you retained earnings and they have given you ordinary shares. Make a note to the examiner and debate it. Talk about the theory. Because remember, it's a long question. The question is probably going to ask you, are we going to expand or reject, or are we going to expand, or are we going to accept, or are we going to reject? Okay, you need to discuss it. So you need to say, well, we have retained earnings. We can use some of it, but this cost needs to be attached to retained earnings because we would assume if we didn't have retained earnings, then we would have to issue shares. And then you could say that they're similar. How you debate it, how you view it, it's up to you. Some people don't want to attach a cost to that, but then that's not correct. Because if you don't attach the cost, then you're going to be accepting any project, even a project that only gives you maybe 2%. Okay, obviously 2% as a return is much better than 0%. Okay, but there is a cost, inverted commas, there is a cost. As you said, opportunity cost. I could leave that money in the bank and make 5, 10, whatever percent, let's say 5%. All right, so then obviously I'm not going to accept that project if the project is only giving 2%. All right, so just keep that in mind when you're answering these test type questions. Okay, I have seen this discussion come up. We do need to consider flotation costs. So cost of issuing shares, a bit more. Okay, you do have to bring those costs into consideration. Right, so here's an example. Okay, if you have the cost of issuing new shares meaning I'm selling those shares, I'm getting help from the underwriter, okay, the investment bank. Okay, they help you to underwrite the issue. They assist you with that process. Okay, it's something that you need to consider. All right, so if you're issuing new shares, okay, the only difference is instead of using the full price, all you have to do is use the net price. That's the only difference. Right, notice it's the same formula you saw earlier. Remember Gordon growth? Dividend 1 over the price plus the growth. Okay, same formula except denominator is now net proceeds. Okay, so to show that, I think I have an example here. Did I? No, I didn't. Okay, but there are examples that where you just subtract. So if the price, let me go back to one of these ones. Okay, here, let's assume I issued ordinary shares, but there was a price, and this was a new issue. Then I would just minus possible flotation costs. Okay, and if there are no costs, then I would say 0. Okay, but yeah, it's up to you. You can decide, right? It's a discussion point. Okay, if the question does talk about flotation costs, I would definitely bring it into the discussion. State the obvious to the examiner. Okay, remember the examiner is looking at your solution and they're trying to understand if you thought about all of these things. Okay, and that's the best approach that I can give you. Exam technique, write down everything, even the obvious. Okay, when you read the question, when you see the share price, write it down in your answer. Put a heading and say workings. All right, and say share price equals and write it down. Okay, because afterwards, then you're going to be using that information. Okay, because we're looking at this in isolation, it's easy. But if you've got a long question, then you need to identify it. Okay, you're looking for these things. Okay, you're looking for the things that I've highlighted here. Okay, so just keep that in mind when you're doing your exam. Write down everything, even state the obvious. If they're asking you to work out the cost of equity, okay, and there's retained earnings and there's normal ordinary shares, debate that. Okay, just mention it. Talk about that point that speaks to the theory. All right, the textbook even discusses it as well. Should you or shouldn't you? It's a debate. Okay, some businesses will say maybe we don't, maybe we shouldn't. Some businesses say we'll have to. It's up to you. Practically speaking, you make the decision. Okay, you're the manager, you're the financial manager. But if we're looking at the calculation, if we're looking at what your niece is going to be looking for, they're going to want to see what cost you attach to this, and they're going to want to see what cost you attach to that, and why. So state the obvious. Tell them that there's flotation cost, and that's going to affect ordinary shares, so I need to remove it. I need to take it out. Okay. All right, and then the last bit in terms of bringing it all together, okay, looking at this costing aspect, okay, weighted average cost of capital, this is bringing everything together. Okay, so all the slides we just looked at, you had a few slides on bonds, you had a few slides on pref shares, okay, then you had a slide on ordinary shares. Those are 3 of the most important forms of financing. I have seen in different past papers, sometimes they give you, for example, a long-term loan, and they also give you debentures. Right, all you would have to do is literally split it. Okay, so then you would have maybe long-term debt there, and then you'll have debentures here. Okay, so the point I'm trying to make with this slide is I'm trying to show you that the weighted average cost of capital is purely a weighting times the cost. The weightings will always be given to you. Right? They'll either talk about rand amounts. So let's assume they said R1,000,000 came from long-term debts. I'm just going to write LTD, long-term debt, just to abbreviate, and R1,000,000 from debentures. Okay, and let's assume R1,000,000. Oh, let's change the numbers a little bit. 2,000,000 rand from pref shares, and let's say 3,000,000 rand from new equity, new shares, new shares issued. Okay, let's just assume that was the example that we were looking at. All right, all you would have to do is add up all the amounts. So 1 plus 1 is 2, plus 2 is 4, plus 3 is 7. So 7 million is the total debt and equity financing. Okay, we spoke about financing. Everything in this section, what we're looking at now until the end, is all about financing, different financial considerations. Okay, it's got nothing to do with the project. It's looking at where are we getting money, how are we managing that money. Right, so if I'm getting R1,000,000 from long-term debts, R1,000,000 from debentures, 2,000,000 from pref shares, and 3,000,000 from equity, what would the weighting look like? Well, 1 over 7 million for that one, 1 over 7 million for that one, 2 over 7 million for that one, and ordinary shares would be 3 over 7 million for that one. Okay, do you see how the weightings work? Okay, the weightings are generally quite easy to calculate. If they give you rand amounts, then please do it that way. Show the total over the amount. If they give you percentages, maybe 10%, 20%, 30%, okay, all of it will add up to 100. Okay, there could be other as well, all right? If there are more, then split it. Okay, show all of it, right? But they'll guide you in the question. I haven't seen more than 4. Okay, I've seen long-term debt, debentures, pref shares, and ordinary shares in one question. I haven't seen more than that in any of the past papers. Okay, so I doubt you'll have more than 4, but it is a possibility. Okay, in reality, in the real world, you could have lots of different forms of financing. Okay, you could have different forms of debt, different types of debentures, different types of long-term debt. It could be corporate bonds, right? It could be government bonds. It could be whatever. Okay, it could be different types of debt. Right, so just remember, WACC is just that. It's the weighting times the cost. Where do I get all the amounts in blue? Okay, remember the cost. So costs of debentures, cost of preference shares, okay, cost of long-term debt. Okay, it comes from what we did earlier. Okay, that's why you have all those equations. Right, those equations, cost of pref shares, cost of bonds, cost of ordinary shares. Okay, those costs is what you would include there. Okay, remember the weightings always add up to 100, right? It has to, right? And obviously businesses would want to target a specific weighting, right? More debt or less debt, more equity or less equity, depending on their preference. Okay, so I have one example to share with you here. I'd like you to help me with this one, okay? Remember, we just spoke about WACC now. We wrote down the formula. It's just weightings, eh? Weightings times cost, just add all of them together. Right, so let's discuss this one. The tax is obviously 28%. That will apply to certain forms of funding, not all. Okay, so let's look at the funding. Cost of debts. Will tax apply? Will tax apply to that cost? Do I need to take the tax into consideration for this cost of debts? Thoughts? Oh, I've lost audio. Let me just check here.
Not sure.
Okay, I
Hello?
think you are
Yeah.
muted.
You need to consider tax.
Yes, you do. Okay, why? It's because it's tax deductible. Okay, debt is tax deductible. Okay, so the cost of debt, we need to take tax off. Okay, pref shares, remember it's a dividend, okay, but it has to be paid. It is paid after tax, right? This is another form of financing. It's separate, okay? We have cost of retained earnings, also separate. Cost of a new share issue, also separate. Okay, so you have one debt, one that's kind of debt but also equity, so in between, and then you've got two that are clearly equity. Those two are equity. Okay, let's see what they've given us. Source of capital. 40% is long-term debt, so that's what they use there. Okay, pref shares, they're using 10% of that, and they're using 50% of ordinary shares. Right, so we're going to use these weightings, and we're going to multiply those weightings by the cost of debt and the cost of equity. Okay, just remember with cost of debt, what must you do here?
Take out your tax.
Exactly.
1 minus the tax rate.
Exactly, correct. Okay, remember I said earlier, okay, we had a debate about retained earnings and ordinary shares. You can have two different views here. You could say, well, if retained earnings is 13%, okay, if we're going to be using ordinary shares, okay, and I'm using cost of equity. Cost of equity, you could say the cost of equity could be seen as the 13 or the 14. Okay, 14 would be better here because they specified ordinary shares. Okay, they didn't tell us, well, I'm going to be using retained earnings. Maybe they don't have retained earnings. Okay, that's why they have to issue shares. That's a possibility. Right, but I'm just showing this working, right, because different questions give you different amounts of information. Right, if I have retained earnings and I've got it as a source of capital, then I would definitely have to show the working. Right, but have a look at it. Look at it. It's just the weighting times the cost. The only cost that you have to take out, tax, is the cost of debt. That's the only one. All the others were given in the question. Okay. Sometimes it's not given. Sometimes you need to calculate it. That's why I'm saying these costs, if they're not given, then you have to go back to those previous slides that we just looked at. Cost of pref shares, there's a calculation for that. Ordinary shares, there's a calculation for that. Cost of debt or bonds, there's a calculation for that. You're working out the I. Okay. Does that make sense?
Yeah.
Yes.
Okay, so just remember, weighted average cost of capital, it sounds very complicated, but it's actually quite simple. Where the complication comes in is here. How do you calculate the individual costs? Okay, the best approach I can give you is this. Okay, look at those individual slides. Gordon growth, if there are flotation costs, use that. If there aren't, then just show -0. Okay, that's the Gordon growth. The other one is capital asset pricing model, CAPM. Okay, those are the two main, and then you can discount future dividends back in time. Right, so that covers another section. There's just a very short little note here about the weighted marginal cost of capital. This is something that I've actually explained in one of the separate exams. It came up in one of the past papers. I've shared with you those past papers. You'll see one. There's a diagram in one of them. You'll see me draw a little diagram. I don't think I've shared it here actually. Let me just see if I... yeah, it kind of looks like this one, okay, where you've got the WACC and the IRR. All right, but it's a bit further on. But it links to what we just spoke about now. Because remember, we just covered WACC, right? So now I can discuss this with you, okay? Right, what did we say WACC is? It's the cost of capital. The business will choose how much debt and equity it is going to use. All right, so when I'm looking at the costs, okay, the red line is representing the costs. Okay, the green line is representing the IRR. Okay, should have labeled this actually, but it would have been a discussion point. So I'm just going to change this to red and green. Okay. All right, so you've got that. Right, remember earlier we worked out IRR. Now we've just worked out WACC. When you combine the two together, okay, you can see that at some point the lines cross over, okay, where you go from accepting projects to rejecting them. Okay, because remember, the projects must always give me more money than the cost of raising capital. Okay, at some point, you're going to accept your best project. Project number one that gives you the highest return, definitely accept that one first. We're going to do that project first. The other projects must wait. We'll raise capital, the cheapest capital we can get our hands on, and we're going to start with the best projects. Okay, then we're going to raise more capital to get the second best project, then the third, then the fourth, then the fifth. At some point in time, money becomes too expensive. We're going to start rejecting projects. Okay, this diagram, you'll see it in one of the past papers. Okay, I actually drew it, and it linked to the information that was given in the question. Okay, but I'm just showing this to you now because it links to what we've covered already. WACC we've now covered, IRR we did a bit earlier, it's just the project. Okay, what the project is giving and what I need to raise in terms of financing. Okay, and that's your cost of capital. Okay, so that's looking at this weighted marginal cost of capital. That's why I went to that diagram, okay, because at some point, okay, remember it's a rand for rand basis, right? We're comparing costs at all the different levels of financing. The more money you want to raise, the more pricey it's going to be. Okay, at some point, money becomes so expensive to raise that you're going to stop raising capital and you're going to say, no, no more capital. We're going to stop accepting projects. We're going to stop buying assets. All right, that's just a little summary. We've looked at everything. Okay, we're almost there. Right, we've got one more set of notes looking at leverage. Okay, and with leverage, then you've got theory that speaks to leverage in terms of that that one chapter. Right, so just in terms of calculations, okay, this is the last like major calculation chapter in terms of notes, where you've got DOL, DFL, and DTL. Okay, you've got different types of leverage. Okay, earlier we spoke about leverage. Okay, when we looked at return on equity. Okay, return on equity, businesses want to perform. Businesses want a return on investment. Leverage can help us to generate more with less. Okay, so which financing is best? We've covered all the financing. Which one do you like the best?
Debt is quite a nice one.
Yes. Okay, debt is a very good form of financing because of the interest deduction, the benefit, the tax saving. Okay, and we're using other people's money instead of our own. All right, so that will also help our shareholders. All right, so best is always relative. Okay, there's no like right answer here. You could have said equity even. Okay, it's up to you. If you said equity, you could have said, well, once I raise capital, I never have to pay it back. Okay, once companies have sold shares, those shares are bought and sold in the market, but they never ever have to pay those shares back. Right, so if you sell equity in your business, okay, you're giving away ownership, but you never ever have to pay anyone back. Right, sometimes you might want to buy back those shares so you get more ownership. Okay, so you don't lose control, but that's a whole separate consideration. But if we just look at financing, if we're just looking at costs, debt is definitely a little bit cheaper. It can be cheaper because of the interest deduction. Right, so now we need to look at leverage. Earlier, I spoke about the DuPont model. You've got three forms of leverage here, operating and financing. If you combine both of them, you get the total leverage. Okay, you'll see I've given you the formulas. There's some slides that you can maybe bookmark there that you'll need to use for those calculations. Okay, total is calculated from operating and financial. Right, so just a little note just to show you what I mean. Okay, have a look at these two companies. Are they the same? Assets, 500,000, 500,000. Liabilities and equity, 500,000, 500,000. Would you say those two are the same companies?
No, the different one has more equity versus debt.
Okay, you've hit the nail on the head. Okay, leverage. The one company is more leveraged than the other. Okay, the one company is using debts and the other isn't. Okay, but it's exactly the same company. Same assets, same equity, same equity and liabilities, the two combined. Sales, exactly the same. Operating, exactly the same. No difference in terms of operations, but have a look at the return on equity. What happens if you calculate the return on equity? Wow, big difference, eh? Debt plan, if you've got debt, 25%. If you don't have debt, 16%. Okay, you can see leverage is good if it can be managed correctly. Right, so leverage, you have two types of leverage. You have operating leverage and you have financial leverage. Operating leverage is what are you doing with what you've got? Financial leverage is what sort of financing are you getting, and does that financing help you to generate better returns? Okay, so if we're looking at leverage, okay, here's the first one, right? Operating leverage. First thing we need to determine is the break-even point. Okay, this gives us some form of leverage because we know what the minimum production level needs to be. Okay, there's a reason why I've given you this is because of the fixed costs. Okay, can you change your fixed costs?
No.
No. Okay, those fixed costs are normally set for a certain period of time. Okay, for example, the lease could be signed for 12 months, 24 months, however long the lease is. Okay, you can't change that. Okay, those fixed costs need to be covered irrespective of your level of operations. Right, so when you're looking at operating break-even, okay, you've got this formula, break-even point, fixed costs over selling price minus variable costs. The leverage that we're looking at relates to that. Okay, so I'm just going to give you a note here. Okay, here's the fixed cost. We just spoke about leverage. Can you change your fixed costs? No, you can't. Right, so when we look at operating leverage, we're looking at that relationship, right, between our income and our expenses, okay, and we're looking at the leverage that we have in terms of operations. Right, for example, if you have lots and lots of fixed costs, right, you're going to have a very, very high break-even point. Okay, versus if you have very low, minimal fixed costs, okay, then you don't have such a very high break-even point. So you start making a profit sooner rather than later. Right, so very basic example here. Just going to share the solution with you. Right, we spoke about the formula. Take the total fixed costs. We said fixed costs here was 50,000. Okay, 50,000 divided by the selling price less the variable costs, 5, gives you the break-even point in units. Okay, that's the break-even point in units. If I multiply that by the selling price, I'm going to say, well, this company needs to sell, okay, in terms of revenue, they need to sell 100,000 Rand worth of sales. Okay, and that would be their target. Okay, and you could maybe give these targets to your salespeople, and you could say, well, okay, minimum, you need to sell 100,000, but you probably have it more than that. You'd probably say, well, you need to hit, maybe double it. Okay, your target for this year, 200,000. Okay, not every salesperson is going to hit that target, all right? So you're probably going to want to aim a bit higher. Okay, you don't just want to break even. Okay, you want to obviously generate some sort of value or profit. Okay, so when looking at operating leverage, okay, you'll see there's a formula, there's a working that we need to do that establishes how much leverage this company has in terms of their operations, right? Because not all companies are created equal. Some companies can do a lot more in terms of operations. Okay, you have different workers, different employees. Some employees are A-level employees. Some are B, C, D. Okay, so operating leverage is looking at that. Okay, looking at operations, looking at revenue, looking at costs, and looking at how well do you manage, okay, your costs. Are you breaking even? And what sort of leverage do you have in the company? All right, so I've given you some more examples here looking at break-even points. I'm just going to share these answers here on screen, okay, just as part of the video. There's the answers there. You've got the units and you've got the rands, okay, the totals. But remember, break-even points, that's the minimal level in terms of operations, okay? This you might even have covered in your other modules, management. I think management also looks at these break-even point calculations. Okay, just to show the leverage, okay, this is leverage. You've got fixed costs, okay? You've got sales, and you've got total operating costs. Okay, remember, what do we say leverage is? Leverage is doing more with less. Okay, so if I'm looking at fixed operating costs, okay, if it's possible to move this line down, okay, that's going to give us more leverage because we're going to be generating a profit sooner rather than later. Okay, so that's something to consider. Remember, we have to break even first. Once we've broken even, now we'll start making profits. Right, so fixed costs, this component, this line is going to determine, okay, how steep or how shallow this is based on operations. Okay, this is a general line. Okay, obviously operations do affect us to some extent, but it's mainly, okay, how overextended are you in terms of your fixed costs. Those fixed costs need to be covered. Okay, we have to pay the rent irrespective of whether people are buying goods or not. Okay, if we're not using the factory, we still need to pay for the rent. Okay, those are things that are fixed. Right, so leverage is looking at break-even analysis. Leverage is looking at operations, and there's a formula for this. Right, maybe just to ask you a few questions here. I'll reveal the answers. I think I've got answers here. It should reveal just now. Operating leverage. Okay, let's think about what we spoke about. If we increase fixed costs, what do you think that's going to do to break even? Would that increase the break even or decrease the break even?
Increase.
Increase the break even. Good. Okay. All right. And then it would be the opposite. Okay. If you decrease the fixed costs. Right. So remember, the most important factor that affects leverage, okay, operating break even, is the amount of fixed cost that you have. Okay. The selling price and the variable cost, that can also affect break even because of the margin. Okay, I think they call this a contribution, if I remember the wording correctly. I think they use contribution to describe the difference between selling price and variable costs. Okay, here's the formula. This is the important one. Okay, so all of that was just theory, just to highlight that concept. Remember, operating leverage looks at your ability to operate, okay, to generate profits that is more than your sales. In other words, some businesses come out with a much bigger profit, okay, for every sale. Okay, remember, revenue is revenue. Just because you've sold R1 million doesn't mean you're going to take R1 million home at the end of the year, the financial year. Okay, R1 million is the revenue. That's the sales. Okay, we still need to bring in all the operational costs into consideration. The operational fixed costs, the variable costs. Okay, those costs will affect your earnings before interest and tax. Okay, so if you compare those two, if you calculate DOL, it's the change in the EBIT over the change in the sales. Right, how do you calculate that? There's the formula. Right, this is the one that I've highlighted here in red. That's the one that you need to remember. Okay, so please remember this slide. Bookmark the slide, highlight the slide. That's the formula you need. Okay, this is in units. If you want rand value, you don't have to remember another formula. All you do is just work out the units and then times it by the selling price. Okay, it's easier just to remember one formula and then just multiply it by selling price if you want sales in rand value. Okay, there's the note again. The fixed costs contribute towards your operating leverage. Right, for example, water and electricity. If you can change water and electricity from a variable cost into a fixed cost, meaning unlimited, right? So you pay a fixed amount irrespective of how much water and electricity you use, that's going to give you more operating leverage. Okay, because I can produce a lot more and I'm going to be paying the same amount. Okay, that's what fixed costs can do to a business's leverage. Right, so it's all about fixed costs. It's about trying to recover. So break even first, cover your fixed costs, okay, but also try to maximize your operating leverage as much as possible. Right, think about all the, even for example, data. A lot of those providers now give you like uncapped data. Okay, before data was very expensive. Every gig you used, every megabyte you used, you had to pay extra. Okay, that was a variable cost. Because those costs are fixed now, okay, if you're running an online business, you can use as much data as you want, okay, and it's fixed. Okay, you have operating leverage. Okay, that can allow you to do more. Same with water and electricity. Okay, if you can fix those costs, those variable costs, it gives you more leverage. Right, and this is what this formula is helping you to calculate. Right, so here's an example. I'm just going to reveal the answer. Right, you've got the information. You would take the information from the question. You would substitute into the equation. This is the equation you need to remember, the one that we just showed on screen. That's the equation you need. Okay, plug in the values and you get this answer. Okay, you get 1.1765. Okay, what does this tell me about the business? This tells me that this business has some level of operating leverage. Operating meaning their fixed costs, because they have some fixed costs, and when we're comparing their fixed costs to their sales, okay, there is a level of leverage here, because when I look at their earnings, okay, their EBIT, their earnings before interest and tax, and I relate that to the sales. All right, they are earning more for every sale that they have. All right, because remember, if you take it back to this formula, if the numerator is bigger than the denominator, you're going to have an amount that's greater than 1, which means that there's leverage. Okay, so when will you have leverage? Is if your earnings before interest and tax is greater, okay, than the change in sales. Right. In other words, you're creating more value, all right, through your profits, okay, rather than a change in your sales. Okay, so if sales go up by, like, let's say 10%, okay, your earnings will actually go up by a bit more, all right, a little bit more. So by an additional 1%, basically, okay, if we're comparing it to the leverage here, right, plus minus, right, in terms of our expectation. Right, so operating leverage, simple formula, that's the formula. Substitute and solve, and then you'll get an answer that describes the leverage that that particular company has in its organization. Okay, the financial leverage, same thing, except we're not looking at sales, we're still looking at EBIT, we're looking at EPS. Okay, EPS is the differentiating factor here. Okay, just to highlight that. Right, earlier we compared EBIT to sales. Right, here we're looking at EBIT to EPS. Okay, remember, earnings per share is after tax and after interest. That's why when you're looking at financial leverage, we spoke about debt as being one of the most advantageous forms of equity to use because of the interest on debt. Okay, interest on debt is tax deductible. Okay, I can make use of that in terms of generating more profits. Okay, a profit, but profit after tax. Okay, profit after interest and tax. Right, EPS is earnings per share. Right, so there's an example here that I've given you. Maybe I should reveal this. Okay. Right, if you're looking at EPS, okay, EPS, earnings per share, right? When I have more debts, I'm going to have more interest, right? If I have more interest, depending on leverage, okay, that interest can help us or harm us, right? So if we had to introduce, let's say, more debt into this business, is there leverage in this business? Well, currently, based on their current level of financing in terms of debt, they're paying interest, 20,000 Rand, 20,000 Rand, 20,000 Rand. Okay, obviously, if I'm going to change that level of financing, if I'm going to introduce more debt, could I potentially increase my earnings per share? Well, the answer is yes, you could, because if we're looking at the relationship between EBIT and EPS, okay, remember, those are two different measures, and they come from the accountant's measure. Okay, remember, accountants will have this information, and an accountant will have this information. Okay, remember, an accountant keeps track of those measures. Right, you can ask the accountant for that information. They'll give it to you. Right, what we need to do is, based on this, we need to determine, is there leverage in this scenario? Does this company have financial leverage? Okay, remember, leverage is doing more with less. If this company has leverage, then we can use that leverage to our advantage. Right? If a company has financial leverage, then we would advise them to consider taking out more debts to increase the amount of debt that they have, because they can use their leverage to help them create more return on investment, okay, more EPS. Right, so this is just a worked example just to show you different levels of EBIT and the different levels of EPS. Right, if you look at this company and you have to break it down into percentage change in EPS and percentage change in EBIT, right, we don't have to draw up this whole table to get the same answer. Right, you can see here, right, it's 0 here, then it's 2.8 here, and then looking at this, it's 5.6. So from 2.8 to 5.6, that's double. Okay, there's a double in terms of EPS. Okay, and then if I look at EBIT, what is EBIT? EBIT went from 100,000 to 40,000. That's a 40% increase. Okay, so a 40% increase in EBIT gave us 100% increase in earnings per share. All right, that's what we're looking at. We're comparing the changes here to the changes there. All right, so let's see what we would get. If you plug that into your formula, you're going to get this answer, 2.5. Okay, 2.5 is the amount, which is the same as what we had earlier. Okay, we had a 40% change over, what is it? 100% change in EPS over a 40% change in EBIT. Okay, so 100 over 40 gave you 2.5. So this company has good financial leverage. Good financial leverage meaning they know how to use debts. Okay, this debt is going to benefit this company. Every additional rand that this company takes out in the form of a loan is going to equate in more return on investment for shareholders, because their EPS is going to drastically improve or increase if their earnings before interest and tax increases by a small amount. Right, so more debt in this business might help them. More debt will increase their leverage. All right, more leverage means more potential benefits, but within reason, obviously. Okay, you don't want to be over indebted. Debt can also get to a bad point, okay, where you have too much debt and you have to reduce it. Okay, there's an example here, another example, just to reveal the answer. This leverage is less. Okay, leverage here, financial leverage, 1.3 compared to the 2.5. Right, so looking at these two companies, okay, obviously this first company, right, this company with much higher leverage, okay, debt in this company would do more than debt in this company, right, in terms of their earnings, right, and their ultimate return on investment. Right, so leverage is just a measure of performance. How can I put it? Or what can you expect? Okay, your expectation on what debt can do for the business if more debt is introduced in the business, because the interest is deductible. Okay, so it's literally take the amounts, plug it into the formula. That formula that I've written here, this one. Okay, that's the important equation that you would just use again and again and again if they ask you about leverage. Right, and then the last equation brings it all together. You don't have to study a new equation. This equation here, not necessary. This equation is necessary because you have an equation for DOL and you have an equation for DFL, okay, operating leverage and financial leverage. If you take both of them and you multiply the two numbers together, then you get the total leverage. Right, total leverage is going to explain, right, how much leverage this particular company has in terms of operations and in terms of financing, because then they can do more with less. All right. Does that make sense? Is that all right?
Yeah,
Yes.
it's coming along.
Okay. I am going to be needing a bit more time. I'm just looking at the time here. It's already 1:30. I'm just checking. I've got about 20 odd slides left to cover. You have two options. I'm going to continue filming. If you do have other appointments, if you're not able to stay with me for the additional 30 minutes, I'm not going to force you to stay if you have other appointments. I do understand. I've gone a bit over time. But if you are prepared to stay another half an hour, I will be able to complete the last bits, if you don't mind. What's the
I'm
view?
good to stay for half an
Yeah,
hour.
Is that all right?
Yes,
I'm
thank
Okay,
you.
great. Thank you. All right, so I'm just going to continue then with the last bit. The next bit is just highlighting the impact in terms of debt and equity. This just expands. This is all theory. There's no workings here. Capital structure and firm value, it's theoretical. Okay, so the next few slides just talk about the capital structure. I have seen theory questions relating to capital structure. They've asked you, or they've asked students in the past to comment, okay, on the capital structure of the business. Okay, just remember this diagram that I showed you earlier. Okay, it's all about debt and equity and which capital is, inverted commas, cheaper. Okay, you don't want to use more expensive capital. A business would always be more inclined to use the one over the other, either because of ownership. They don't want to give away too much ownership because equity means you're giving away ownership, but you never ever have to pay back those shareholders. If someone buys shares in your company, that's it. They keep the shares forever. Okay, you never ever have to pay them back. That's like money for free, basically, inverted commas, that you never have to pay back. The problem with debt is you have to pay it back, but at least you don't lose equity, you don't lose ownership, right? So when you're discussing this, poor capital management can result in a high cost of capital, right? So when you're making decisions, just remember you need to keep costs as low as possible, right? So how do you do that? Here, ratios. Okay, that's why I mentioned this earlier. Okay, I have seen 1 or 2 questions where they've asked you to calculate the debt and equity. Okay, so financial leverage, you have those additional calculations. Definitely calculate DOL, multiply that by the DFL, and get the DTL, the total leverage. Okay, you don't have to worry about DTL. As long as you can calculate those two separately, okay, you can calculate the total leverage. Okay, leverage is useful because it tells you how effective a company is in generating a return on investment. Okay, remember, here we looked at EPS and we're looking at sales. Okay, so just to keep it simple, with total leverage, you're basically saying, in terms of leverage, how much more am I doing? Every time I sell something, if I had to increase my sales, how does that translate to an actual payoff? In other words, earnings per share. In other words, money in the owner's account. Okay, in the shareholder's account or in the owner's accounts. Right, that's total leverage. Total leverage is looking at both operating and financing. Right, you have to operate, you have to do, okay, you have to sell. But at the same time, you have to manage your finances, and sometimes you can use more debt, which can benefit your business. Right, so I'm just highlighting this because it speaks to what we have here. Leverage. How do we evaluate the company's ideal, inverted commas, ideal? Remember, best. There's no such thing as best. It's ideal. It's appropriate. Okay, so as long as you've answered the question, but again, stating the obvious, I would definitely talk about debt. I would definitely talk about equity. I would also talk about the control. All right, and I would talk about the benefits of debt, and I would talk about the benefits of equity as it relates to financial leverage. Okay, so we know debt is better, okay, because of the interest deduction. You might mention that, but you can also say, well, equity is also good because equity, you don't have to always pay out dividends. Right, we're going to get there. You're going to see dividend policy shortly. Okay, you can sell shares in your company and you can never ever pay a dividend. And your shareholders are just going to have to live with that, okay? Because they made a decision to buy shares in your company. And if you're not paying a dividend, well, they knew what they were getting themselves into, right? You don't have to pay a dividend. If your dividend policy is to not pay a dividend, you're not obligated to. But if your dividend policy is to pay out a dividend, then you should, right? And that comes down to what we spoke about earlier, managing your capital structure, balancing debt and equity. Right, so this is that note about the pecking order. Pecking order means if you're asked a question about capital structure, okay, always make sure that you discuss retained earnings first. Why, inverted commas, it's considered the cheapest form of capital financing. We don't even have to raise that capital. We literally just go to the bank, take the money we need, and invest it where we need to. Okay, debts would be the second best. Why? Because of the interest deduction. Okay, again, you can discuss this. Remember, it would relate to the scenario. So they'll give you a company, they'll talk about the capital structure, they'll tell you what they have access to. Then if they're asking you to comment on what's optimal or what's best for them, make sure you always work through the different levels of debt or the different levels of equity that they have. Okay, external equity is fine, but it's expensive. Okay, flotation costs, issuing new shares. Okay, banks need to be involved. Okay, you need a investment bank to help you issue new shares. Issuing new shares. Okay, optimal capital structure. That's looking at the best mix, right? Debt and equity, right? Remember, we always want to keep cost of capital as low as we can go, basically, right? The lower, the better, right? So as long as you can use cheap money, Okay, if money is cheap, you're going to get as much of it as you possibly can. Okay, when debt is cheap, use a lot of it. Okay, if debt gets more expensive, use less of it. Pay it off as soon as you can. Start using other forms of equity. Right, and that's what businesses have been doing. When debt was cheap, everybody was taking it out. Okay, now it's more expensive. Everybody's trying to pay it off and get rid of it, and now you're using other forms of equity. Right, it's very simple. It's very common sense, but you need to remember the calculations. All right, so I've put a note here, especially for the textbook. Right, the textbook gives you a discussion here about capital structure, and this is where I spoke about that whole idea of maximizing wealth. Right, remember we spoke about value is key. Okay, when we looked at NPV, so for example, NPV was value. Okay, NPV greater than 0, that's good. Okay, that's a measure of value. Right, when you're looking at capital structure, here you need to look at share price. You need to look at firm value. This is something that I have seen in, it was like one past paper. I don't know why they tested it, but they did. Firm value. Firm value is net operating profit after tax divided by WACC. Okay, it literally came up in one exam, and then it never came up again for a few years. I don't know if it'll come up more recently. It might. We don't know, but it is discussed in the textbook. They talk about this idea of ideal or efficient capital structure. Right, it's interesting reading. This diagram actually comes from the textbook. Right, but just because of time, I'm not going to mention it in too much detail. But what I am going to say is, if you have debts, okay, if you have less debts and you start increasing the amount of debt you have, that can help you, but at some point it's going to harm you, and that's where you need to get the balance right. Okay, it's like an individual, right? We all need debt, we need some of it, but you just don't want to get yourself in a situation where you have too much of it. Right, and even if you look at South Africa at the moment, they're talking about the high levels of debt. For example, Eskom with load shedding and how much debt they have. They've got a huge amount of debts. Right, that company is becoming a problem, okay, because their debt ratio is getting more and more and more worrying in terms of its current level. 30% is low, 60% is a bit higher. That's twice as much debts. Right, if you had to constantly increase your debts, at some point in time you're going to get into trouble. Okay, as long as you're doing it responsibly, as long as you are maximizing value, as long as your firm is increasing in value, then we're not going to be opposed to it. Right, but it's about management. It's about keeping track of how much debt and equity we have. Okay, so that's the little notes. All theory, there's no workings there. It's literally pure theory. Right, then we've got dividend policy, also all theory. Okay, there's no calculations here. Okay, leasing is the last bit. Okay, so you've got quite a few theory chapters here. Study Unit 8, dividend policy. Just a note here, when looking at dividend policy, you've got two important things to remember, and I've written them down here. Retention and payout. Okay, remember, those businesses that were operating, where's that picture? This business. Okay, forget about the funding now. Okay, we're looking at the actual business. We're looking at the business, okay, and we're looking at what they've actually done. Okay, so in other words, we're looking at performance. How much profit is this business generating? Okay, how much money is this generating? Okay, and the profit is what we need to consider, because that profit was created through the operations of the business. So you raise capital, okay, you use that money responsibly, you created value, you maximized wealth, you now have profit. Okay, the big question mark is, what do you do with that profit? That's the big question mark. Sometimes you pay out a portion of the profits. We call that a dividend. Okay, dividends represent the cash flow that investors receive, okay, as part of the equity investment. Right, remember, if you've sold equity in your business, you've given up part of your company, shares in your company. Right, those shareholders share in the profit. Okay, a payout ratio is what is used to describe that. Okay, so payout ratio, how much you pay out. Retention, how much you keep. Remember, they both need to add up to 100%. right? And a company will choose, and it'll depend on how much they retain, how much they pay out. And this is dividend policy. So when you're looking at this chapter, it's internal. Okay, the board of directors, they'll decide how much they're going to pay out, how much they're going to keep. Okay, and it's all part of their policy. Okay, when they pay out dividends, it's good. Okay, it's very good. Right, so when we're looking at dividend payout policy, there's just a note here, a little note about cum div and ex div. This is all related to the dividends, okay, and what the dividend policy is. Okay, when you have a payout ratio, okay, the payout is going to be done, okay, on a particular date, but there are different dates. Right, when you announce the dividend, okay, there's going to be a date where the company, or not the company, the shareholder is going to pay or get paid that dividend from the company. Right, so cum div means including the dividend. Right, so if you're a shareholder between the 1st of March and the 1st of April, okay, you will get the dividends. Right, there is a registration date in terms of when the dividend will no longer be paid to you. Right, so if you sell your share after the 1st of April, okay, and you're no longer a shareholder, then unfortunately you're not going to get the dividends. All right, so we need to remember, what is a dividend? It's a payout of profits. Let me ask you this question. Do you pay taxes on dividends? Is there tax on dividends?
Yes.
Yes, there is. Okay, but it's a separate tax. Okay, will you show taxes on dividends when you're looking at financial management? No, you won't. Okay, remember, this is financial management. You're looking at internal, you're looking at the company. Okay, the company is not going to include tax as part of their cost of equity. Okay, remember, dividend policy is after tax. Okay, it's not a cost. The shareholder pays it. You
It's
don't
like
as the company.
income tax. Yeah.
Okay, it's a withholding tax, right? So if you have shares, okay, as the investor, you pay the tax, not the company. All right, the company pays the dividend after they've been taxed. Right, so they can't get taxed twice, they only get taxed once. Okay, the company gets taxed and then the investor gets taxed. Those are two different taxes. Right, so just remember it's separate. When you're looking at dividend policy, please don't take out tax in any of those calculations. Okay, the only calculation that you take tax out is debt. Okay, debt is the only one. Okay, this is just theory. The dividend policy, maybe just to show you this. Okay, coming back to this whole idea of a residual. Okay, if we're paying out a dividend, where does that payout come from? We just spoke about it.
From your profits.
Exactly, it comes from the profits. Right, so if we're looking at this relevance, okay, relevance of the dividend policy, companies pay this residual, okay, when there's no more acceptable projects. Okay, I have seen a question about this where they've actually asked you to calculate if dividends will or won't be paid out. Okay, remember we spoke about this? Okay, now we can bring in the dividends, right? What we know what a dividend is, hey, it's a payout. Okay, when does a company pay out a dividend? Is when there is any surplus profit that can't be used elsewhere. Right, in other words, a company will not retain all of their profit. A company will pay out a percentage of their profit. That could be maybe 20%. All right, they're not going to pay out all of it. They'll never pay out all of it. Okay, they will always keep some of it because they need to create almost like an emergency fund if things go badly. For example, global pandemic, war, recession, load shedding, whatever. Okay, you want to keep some profit inside the business. You're not going to pay out all of it. Right, but another consideration, when they talk about, this is theory, okay, you'll find this in the textbook. Right, there's a note here about the investment opportunity schedule. Okay, I explained it earlier. If I'm making a profit, if I'm accepting projects, are we going to be using that money or are we going to be paying it out? What do you think? Okay, the question was, if I'm accepting projects, am I going to be using that money to accept more projects, or Or am I going to be paying out that money? Anyone? Let me just check. I think you might be on mute if you don't have audio. I think
Sorry, I
Josh
was
is
just
trying
getting
to
bad connection.
answer. Damien?
Yep. Sorry, can you repeat the question?
The question was, if you're accepting projects, are you going to be paying out dividends?
No.
No. Okay, so this concept, right, of a residual, right, companies may only pay out profits when they no longer have any acceptable projects or projects that aren't going to be generating any value, right? So factors that have influenced dividend payout or the dividends. Okay, we're only going to pay out a dividend if we don't believe that we can't use that money elsewhere. Right. So when you're looking at theory, okay, this is all part of the textbook. The textbook is very good. I must compliment the authors. The textbook that they've prescribed, Gitman, especially the newer ones, the newer ones are quite good because of the newer case studies, but the older textbooks are still good. The theory is still the same. If you've read through some of it, okay, you'll see that firm value is key. Okay, so remember, what's the objective of a business? We spoke about maximizing wealth. Okay, that was on one of the slides. You don't ever want to give away too much money in the form of a dividend where you're going to now have to raise more money elsewhere. Right, that's why this is so important. Okay, because you can see at some point in time, money becomes very expensive. Okay, what happens if we cannot raise capital? If the weighted average cost of capital is more than the IRR, that means this point is the point where we're going to stop getting new projects. We're going to stop investing in new assets. That could be a problem. Right, so businesses want to keep capital available. They don't ever want capital to run out. Businesses want to only pay out, literally pay out what they can, inverted commas, afford to pay out. Because you don't want to pay out everything and then go take out a loan. If I keep it really, really simple, just to try to give this theory some color, think about it as an individual. Okay, all of you are probably earning some form of salary with the work that you do. Okay, would you go literally pay out all your salary and then go take out a loan and then use that to operate a business? That wouldn't make any sense. Okay, you would literally be paying out all the money and then getting it again, but through a loan. That loan would be more expensive than the money that you've generated on your own. Okay, so just think about it in terms of payout and retention. Okay, payout, only pay out money if it cannot be used elsewhere. Right, if earnings, okay, will not increase firm value. Right, so a firm will only pay out a dividend if they believe that there aren't any other better places to invest that money or that capital. Okay, so there's quite a lot of theory that talks to firm value. Right, earnings are paid out or retained, okay, only when it does not affect firm value. In other words, we're not going to harm the business. It'll only help the business. Okay, you don't want to pay out more profits and then have a situation where this is earlier on like that. Okay, that would be bad. Okay, we want to try have capital for as long as possible, okay, without having to raise more capital. That's very, very expensive. Okay, remember at the beginning, capital is cheap. All of that is retained earnings. At some point, it gets more expensive. All right, so you want to keep all of it. If you don't retain profit and you pay out everything, then you're going to have a problem like that. Okay, money is going to be very expensive very soon. Okay. All right, that covers that. Then you've got some notes about different types of policies. I haven't really seen them test this. The only thing that I've seen them test this is in theory questions, multiple choice. Okay, so I'm just going to ask you to just have a look at those three policies. You've got a constant payout, you've got a regular payout, and then you've got a low, regular, and extra payout, where a special dividend is declared. Okay, these are just some other management considerations. Also, never seen this ever come up, right? But the textbook covers it. It's covered in the chapter and the content that you would have looked at. They might or might not give you theory, multiple choice questions about it, but from what I've seen in the past, never really seen anything come up about this. The dividend policy is yes, but maybe like 1 multiple choice or 2 multiple choice. Nothing hectic. Okay. Last working chapter, and then we can wrap up. Leasing. Okay, this is a nice chapter because there are workings, but workings that relate to these 2 key concepts. Okay, what is a lease? We spoke about it earlier. It's inverted commas, renting. Okay, leasing, it's using an asset without owning it. What is the benefits? Well, think about it. You don't always have to raise capital. Okay, you don't have to raise 100 million to buy a massive building. You can lease the building at a fraction of the price. As long as you pay your monthly rent, you can use that nice massive building, okay, and the company can operate and you can run your operations. Right, so leasing is very powerful. 2 types of leases you get: operating and financing. Okay, operating is when you have ownership, okay, where the lessor keeps ownership. Let me give perspective. There's 2 roles. Lessor is the person, okay, who gives the permission to the lessee to use the assets. The lessee is the person, okay, that's basically renting, right? So if I talk about property, lessor would be the landlord, lessee would be the tenant. Okay, that's the best example I can give you to explain the difference between the lessor and the lessee. Just note though, if it's a financial lease, ownership will transfer at the end of the lease. Okay, this is actually very powerful because it's almost like a use to buy type of situation, or like not used to buy, lease to buy. Okay, so financial lease, where payments are made, but at the end, the lessee gets the option, okay, to own or take over ownership of that particular asset. Okay, once the lease has ended. Right, it's almost like an exit strategy for the person owning the property. Right, it's for example, it's like you have a second property, you're renting out to the tenant. Okay, you have a financial lease with them. You tell them, okay, rent out the property for the next 5 years. At the end of 5 years, I'm going to give you a specific opportunity to buy the property from me as the owner. Okay, for you as the owner, that's a brilliant financial option or access to capital. Why? Every month, money is going to come in, and at the end of that agreement, you're going to get the full amount of money coming in because now someone's going to buy that property from you. Okay, and that's the difference between a financial lease and an operating lease. Okay, a financial lease is very powerful because of that capital that you can have access to if you're the lessor. Okay, remember, as the lessor, you want capital, access to capital, right? So if you can get your full amount of capital at the end, and remember that building is probably going to increase in value, right? So you can sell that building at the end of the lease at double the value. So now you've got someone renting it out, and then at the end of the lease buying it from you, okay? And then you can take all of that capital and go do something else with it. So that's something to consider. Financial leases, great in terms of financial management, okay, if you're the lessor. Operating lease, good for the lessee because you don't need to raise capital. Okay, so I'm just giving you the pros and cons because you need to decide, okay, when is it better to lease and when is it better to purchase? Right, there are different types of arrangements that you can have. You can also have a sale and a lease back. That's also a nice financial management consideration, okay, where the lessor acquires an asset already, okay, and literally leases it, okay. So basically, sale and leaseback is like, let's say you're in you're in a spot of bother, okay. The company is struggling, all right. You have a massive building, but that building is becoming so expensive to run, okay. But you're running a business. What you could do is you could sell it and you could lease it back. Right? What does that do? That gives you an immediate capital injection because now you can get money from your assets. Okay, that property could be worth a few million, 10, 20, 30 million, depending on how big the building is. And if you're running your business from that building and you're getting into financial difficulty, you could say, well, okay, I need to get rid of this building, but I don't want to leave the building because my factory is in the building. All my employees are working from this building. What can I do? I can sell it and then lease it back. All right, so a big property company, Growth Point, Redefine, whoever, they're going to say, we'll take your 10 million rand building, we'll give you the 10 million today, and then we'll sign a lease with you, and you can rent it and you can use it for however long you want to. All right, so you're going to get 10 or 20 million immediately, and then you can use that money, save it, invest it elsewhere, or put it back into the business, and then just pay the rental to Growth Point every month. All right, so at least they still get their rent. They're happy. They own the business. They've got a tenant. Okay, but you've been able to create financing. Remember, everything we've looked at now, after the break, every single chapter is about financing. How can we use it to get access to capital, or how do we use it to get access to resources so we don't need capital? Right, so the last thing we need to do is this calculation. Okay, leasing versus purchasing. Right, and I've given you those printouts, those slides, those PDFs, just so you don't have to write any of it down. Okay, so please just work through it with me. I will show you the calculations just now, but you need to understand the theory. Okay, so you have a consideration. Do I lease the building or do I purchase the building? There are two important considerations that you have to make as the financial manager. The first thing we need to look at is the impact on cash flows. Right, so everything you do here is time value of money, similar to what we did before, except applied in context. All right, so the first option, do we lease the asset? That's option number 1. Option number 2 is we borrow to buy. Okay, that's the purchase. Both have their pros and cons. Okay, the second thing that we need to consider is how much money do we actually have available currently? Right, if we do have enough funds available, then it's always a good idea to purchase and own the assets. But if you don't have existing funds, if financing is a problem, then you have to go with the lease option, okay, or the borrow option. All right, so borrow to buy or lease and buy. If you have the money to buy, go ahead, buy. Okay, buy the asset, own the asset. Assets are good. Okay, you can't go wrong with more assets. Right, but the decision that we're looking at here is this, okay? Lease or borrow and buy. Okay, I have to make that point obvious. Okay, the reason why I'm mentioning this is because sometimes students get confused. They think it's lease versus purchase, but purchase in terms of you've got money to purchase. Okay, if you've got money to purchase, then there's no debate. Okay, if you've got the money, buy the assets. Okay, if you don't have the money, now you need to do the calculations. Okay, because remember, everything we did is looking at financing. Okay, or everything we're doing now is financing. So just remember, borrow or buy, or lease and buy. Okay, so I've given you an example. Okay, I've just shown you some workings here. We've looked at this. Okay, remember, everything we do in time value of money, we draw a timeline. Okay, and you discount those amounts back in time to see what the amount will be worth at the beginning, okay, at time 0. Okay, that's what time value of money is. Okay, work out NPV, see if NPV is positive or negative, right? So even for something like this, you're still going to be doing the exact same thing. Okay, you're going to be working out what the present value is going to be. But be careful though, okay? Here, the present value is looking at costing, not value, because you're looking at leasing versus buying. Okay, and that's something I need to highlight and underline, okay, because there is a difference. Right, here the option that's the smallest is actually better, okay, and you'll see why when we do the calculation. Okay, so just remember, for leasing and purchasing, you must go with the smallest amount. Why? Because that amount represents the cost. Okay, you're present valuing your future cash flows back in time. Okay, and you're comparing that to the two. You're looking at leasing and you're looking at purchasing, and you're seeing which one is better. Something else to remember, SARS, if you have an operating lease, okay, an operating lease is good. All right, that's why a sale and leaseback is good, because if you sell your property, sell it to Growth Point, and then rent it from them, all right, now you're going to be paying rent to them. All the rent that you pay to Growth Point, you're going to claim all of that from your income tax when you submit your SARS tax return every year. Okay, as the company, that's good. Okay, so leasing is good. Why? Because it is deductible. Right, that's why most businesses, especially big businesses, even As far as I know, I think even that nice, pretty Discovery building that they built, if I'm not mistaken, I think Growth Point actually owns that building, and I think Discovery is actually just leasing it, if I'm not mistaken. Okay, because they can write off so much tax benefits. I mean, if that lease is like 100 or, I don't know, like 2, 3, 4 million rand a month in terms of a lease, they're going to be writing all of that off because it's an operating expense. Right, so businesses generally prefer leasing rather than purchasing. Right, there are pros and cons to both. It comes down to financing. Do you have the money? Do you have the money to raise capital to build it and to own it? Or is it better just to use it and let someone else own it and let them have the problems of paying COJ and maintaining the building, etc.? Right, so that's the focus. Keep that in mind when you're looking at this example. Okay, so here's the last example, just looking at this whole discussion between lease versus buy. When you're looking at leasing a vehicle, okay, you've got a certain amount. Okay, so the vehicle that we're going to be leasing, okay, 24,000. It's possible to secure a 5-year lease at 6,000 per annum, okay, with an option to purchase the vehicle at 4,000 after the 5 years. It doesn't matter what it is. Okay, so this is just a simple example with easy numbers to calculate. We need to decide, okay, is it better to purchase or is it better to lease? Okay, so I've highlighted the blue because that's the lease, that's option 1. Okay, option 2 is the actual purchase. Just in terms of leasing versus purchasing, when you're looking at leasing, leasing is always easier to calculate because you don't have to worry about the borrowing costs. Okay, remember, interest is tax deductible, but that's only if you're purchasing the building. Right, so only if you have debts. Okay, remember, debt is good. You would definitely take out debts to buy this building, asset, vehicle, whatever it is. Okay, debt is deductible. Right, but it only applies to the owner. Okay, if you're the lessee, you don't get the same benefits. Why? Because your whole lease, the whole rental, is deductible. Okay, so the nice thing about leasing versus buying, okay, if we're looking at leasing, the only thing you have to look at is the actual lease. Okay, the amount of money that you're going to be paying. Right, so the lease is 6,000. So let's go to the calculation. Okay, it's on this screen. Let me show you the calculation. You've got this already, so please don't write this down, just have a look at it. Okay, let me just make it bigger. Okay, there's the lease payments. You've got 5 years to lease this asset. Okay, remember, whether you own the building or own the vehicle or not isn't important. As long as you can use it, that's important. Right, so the use is important. I don't have to own the vehicle. Okay, and vehicles, I mean, who wants to own the vehicle if it's going to depreciate every year as well? Right, it might be a better idea just to lease these things. That's why certain things are leased. For example, printers. Maybe you're working at a company where they lease all their printers. Okay, printers, they get so old so quickly and they need to be maintained so often. Okay, instead of buying them and maintaining them, rather just lease them. Let someone else focus on the problem. Okay, and if you're leasing it, remember this full amount is tax deductible. Okay, that's why you have to take off tax. Okay, so in my question, I need to go back to the question. What is the tax rate here? Okay, assume 30%. Okay, so if we're assuming 30% here, if I'm looking at the after tax, remember after tax is the after tax cost. Okay, we're looking at costing. We're looking at how much is the lease going to cost us. Okay, those are the amounts that we're going to have. Okay, and remember, at the end of the lease, okay, there's going to be an additional cost because I think this was there was an option to buy, right? Yes. Okay, an option to purchase the vehicle at 40,000 after the 5 years. So this would be a financial lease. Okay, if it was operating, then you wouldn't even have that. Then you would eliminate that. Right, operating is very easy. That's just a normal lease. Financing, you have this option to buy the vehicle. Okay, so I can use the vehicle for 5 years and then purchase it. Remember, this vehicle will be worth less. Right, so I've used a 24,000 Rand worth vehicle, a vehicle that's worth 24,000. I've used it for 5 years. After 5 years, I'm still the owner, but now I'm buying it for 4,000. That's good financial management. Okay, but it cost you 6,000 Rand a month in order to use it. But at least I don't have to worry about all the maintenance, etc. Okay. Wrong page, sorry. Back to this page. All right, if I'm looking at my cost, those are all the costs that we've just looked at, okay, including that additional 4,000. Remember, you're present valuing this money, so you need to take these amounts back in time. Okay, so I've shown you there. That's the calculation that I've done on my calculator. This amount is the future value. There's the future value. That's the I and then the N. Discounted back in time, discounted back in time, discounted back in time. Is there a shortcut? Yes, there is. There's always a shortcut. I don't know how many of you know this, but remember that cash flow function that we used earlier when we did net present value? Okay, you don't have to do it like this line by line. You could, but it just takes too long. What you could do is on your calculator and try it. Test it. We won't test it with the other one. I'm just going to test it with this one because it's short. On your calculator, put in, so you both have sharp, so put in 0, enter. Okay, then put in all of these amounts. Okay, it's not referencing it. Let's do that. Okay, put in all those amounts. Okay, enter, 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 enter. Okay, I'm showing you a shortcut. Okay, so you don't have to do this like this. Okay, I just did it like this to show you the interpretation. Each amount needs to be present valued back in time. If I make my time 0, 0, that's very important. Then the calculator can do the discounting for me in one step. Right, put in all those amounts. Okay, put in your interest rate. Remember interest rates after tax, eh? So in the question here, I gave 9%. All right, so 9% less the tax gives you 6.3% after tax. Okay, if you take all of those amounts, if you put I as 6.3% and solve for NPV, you should get the same answer there. Do you get it? Did you try that? 0 as the first enter, and then all of those amounts enter, 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 and then put your I as 6.3, solve for NPV, you should get that figure. Did that work?
Yeah.
Was that a yes, hey Damien?
Yes.
Okay. All right.
Very
That's
nice.
how you do it. Shortcuts. Okay. So you can do it using this long method, but it's much easier to do it in one step. That's why I've given this to you at the bottom here. Right, if you know how to use your calculator, right, you can save yourself a lot of time. But be careful. If you do it this way in the exam, then please mention it. Show all the steps. Tell the examiner, I'm discounting all those amounts back in time using my calculator, inserting this rate, and getting that answer. Okay, so yeah, there's nothing wrong with using a shortcut, but make sure you've explained it in your working so the examiner knows, okay, Damien knows how to use his calculator. He's using this to help him save time to get to the net present value. Okay.
Yes.
Is leasing okay? Leasing is very easy. The only thing you need to look at is the lease. There's nothing else. Happy
So
with the
then
lease?
you-
I know, Damien, I
yeah.
think you had a specific question about this. Parosh, are you okay there? I saw your audio is now
Yes.
on.
Yes.
Did you manage to get that as well?
Yes.
Okay, well done. Great, great, great. Okay, then we need to look at the last bit. Let me go to the lease, not the lease, the purchase. Here's the purchase. Okay, this looks hectic. Why? Because of the amortization. Let me go back to the slide just to go to the next page. Okay, on this page, I'm going to delete that just so you've got the additional working here. Okay, when you're leasing, you're only looking at the lease. When you're purchasing, now you need to think, well, I'm the owner. Okay, as the owner, you're always going to have more headaches to take care of. Okay, you've got to maintain the asset. You've got to pay off your bond. You've got to keep track of all the interest payments, etc., etc. Okay, you even have to account for depreciation if the asset is depreciable. Right, so I've used that for a vehicle, okay, because a vehicle will definitely have depreciation. If you buy an asset, if you buy land and buildings, okay, you can't depreciate land and buildings. Okay, that doesn't exist. Okay, there are certain capital allowances, but that's something different for buildings. But yeah, for vehicles, for machinery, printers, technology, equipment, whatever that is, okay, leasing versus purchasing, okay, depreciation is powerful, okay, because it is tax deductible. Okay, SARS talks about depreciation as a wear and tear allowance. Okay, so I've given you a note here. The loan payments, the maintenance, as the owner, you can't get out of that. Okay, you will never ever be able to get out of that. Okay, if you're the owner, you have to pay off your loan, your bond, okay, and you have to maintain the assets. It is what it is. Okay, that's the role as the owner. But what happens is the tax savings. This is a huge benefit. Okay, if you're an owner and you have interest, depreciation, and maintenance. Right, those are tax deductible. Right, so when we're looking at a purchase, okay, remember we spoke about this. It will only work here if you're borrowing to buy. Okay, borrow to buy, not if you have existing funds. If you have existing funds, you just buy. Okay, buying is always the best option. Okay, it's only if you don't have enough funds. Remember, it's financing. I'm a bit short on money. I want the asset, I need the asset, but now, am I going to rent it or am I going to borrow and buy it? That's what we're looking at, right? And that's why this is powerful, because you have two things. You've got the depreciation and you've got the interest. Okay, those are two things that give you massive write-offs in terms of deductions, okay, because the loan could be quite expensive and you'd have to pay off all the interest. Right, so to show you my calculation, I've done it for you. Let's go back. Okay, ignore the second half for now. Don't look at the next half. Okay, don't look at the next. Don't look at this. Okay, just hide the bottom bits. Okay, just look at the top bit for now. Okay, when you're looking at leasing versus buying. Okay, when you're looking at the decision to buy, this is the first thing that you need to draw up. Okay, this is a normal. I think what I will do is I'll get an Excel spreadsheet. I'll just copy paste this in a separate sheet and I'll send it to you so you have this as well. I just did it as PDF, so it just looked a bit better. But I'll send this to you as well. You might even want to use it if you want to for other examples. But yeah, if you have a purchase, there will always be a loan. Okay, hopefully you can do time value of money and you can calculate the loan amount. Okay, the loan amount is calculated using PMT. Maybe just to write some notes here. PMT is the loan amount. Okay, that's the monthly installments. Okay, that you would calculate based on your agreement with the bank. Okay, the financier, the person giving you money, the person lending you money. Right, so when you're doing this calculation, the one thing you have to calculate is your payment. What is the payment going to be? Every single month. Once you've got the payment, then you need to do the amortization. Okay, amortization, the table looks like this. You've got a loan payment amount. That loan amount is going to pay off a part of the principal. Okay, that loan amount is going to pay off a part of the interest. Okay, and you can see that here. There's it there. Okay, so you've got this 6170. A portion is paying off interest in year one, and a portion is paying off principal. Okay, as you continue to pay off your loan, the principal will decrease and will eventually get to zero. Okay, your interest will get smaller, right, because the outstanding balance will decrease. Okay, that's the principal. Principal is the outstanding balance. Okay, that loan payment will never change. That's an important column because you need that column in your lease versus buy calculation. Interest, okay, this column also important because interest needs to be calculated, okay, in terms of your deduction. Right, so those are two columns that you need, interest and the loan payments. Okay, the rest is just amortization. Once you've done that, then I've got these two. Okay, there's the loan payments, there's the interest. Okay, it comes from the table above. Okay, if you're wondering where those figures came from. Right, all the other information came from the question. All right, the question said, I've got maintenance costs of 1,500. Okay, depreciation was given as 5 years straight line. Right, so if I take my asset amount, remember the asset amount was 24,000. Okay, that was buying the new vehicle. Okay, so if I buy the vehicle, it's 24,000. Okay, if I divide that by 5 years, I get the 4,800. That's the depreciation every single year. Okay, that's the amount for this column. Interest we spoke about, deductions. That's something we need to speak about. Okay, so remember earlier on the slide, okay, we spoke about tax savings. Okay, when I'm looking at these deductions, I need to remember, because I'm the owner, I own the assets. When I do my tax return as the owner of the assets, I get to claim all my maintenance because that's an operational cost. Okay, I own the vehicle, I'm renting it, not renting it, I'm using it. Okay, but the maintenance is operations. Okay, you're paying for someone to repair the vehicle, the equipment. Something else that I'm also going to benefit is all the depreciation. SARS will let me claim all of that. Okay, so that's going to decrease my taxable income. And then the other thing I need to remember is all the interest. Okay, that's why I've put this in yellow. Okay, I've highlighted those three in yellow. All three of these are deductible. Okay, so if you add them all up, you get that answer. Okay, once you've got the deductions, all you do is you times that by the interest rate, not interest rate, the tax rate. So the tax rate here was the 30%. Okay, that's the 0.3. If you multiply this by 30%, you get the tax savings. Right, and that's the last figure that I need. Then I can do the calculation that I've got here on screen. Okay, loan payments plus maintenance minus tax saving gives you the after-tax cost. Okay, so I've tried to put blocks around these. There's a block around that one. The loan, the maintenance, and the tax saving. Okay, add those two minus that one gives you these figures. After-tax cost of the buy, the decision to borrow and buy. Okay, again, do we have to do it manually? Please don't do it manually. Use your calculator. Put this into your... Did I show it? Let's see. No, I didn't show it here. Okay, use your calculator. Just remember, Y0 must be 0. Okay, and then each and every one of these. Enter, 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 enter. Okay, once you've put all of that in, all right, what is the rate? We had it earlier. Where was my rate here? It was the 9%, eh? Where did I put the rate? Here, 9%. Okay, 9% after tax. Okay, and then if you discount that back in time, you're going to get the right answer. Does that make sense?
Yes.
Sorry, I didn't hear that. Was that a question?
No, makes sense.
Makes sense. Okay. All right. So when you're looking at lease versus buy, just remember certain expenses give you tax savings. Okay, the tax savings is the most important. That's the only thing that we need to look at. Right. Then we look at which is bigger. Right. So this one we had 22,369. This one we had 20,000. Which was cheaper in this case?
The lease option.
Yeah, in this case, the actual leasing was better than the buying. I think I've shown that here. Yes. Okay. Present value of decision to lease. Okay. The buying cost more than the leasing. Okay. So leasing is actually better in this scenario. Okay, because maybe the type of asset, the number of deductions, and so on. Okay.
And
Right. So that's the last bit of calculations. Right, Shem, I don't want to keep you too long. I know we've gone quite over. I'm just going to ask you to have a look at the last few slides, which is theory. Okay, when looking at study unit 10, I've never seen any calculations here. It's all been theory, just looking at these mergers and acquisitions. I've only ever seen this in multiple choice questions, short questions. Okay, when you're looking at mergers and acquisitions, here we're looking at buying other businesses, acquiring control. Sometimes it can be friendly. Okay, if it's friendly, it's more of a merger. Okay, if it's a takeover, okay, where there's an acquiring company and a target company, it's more hostile. Okay, when looking at these different types of mergers and acquisitions, okay, you have horizontal, vertical, and all of those. I think I've got them here on one of the slides. This is just looking at restructuring. Okay, when businesses, again, why do you do this? To raise capital. Okay, everything we looked at here is always about money in mind. Okay, raising capital. Sometimes you want to merge with someone else because they have more resources. They've got lots of money, okay, but you've got lots of resources and you can work together. Then that could be a friendly merger. Sometimes it's control. You want the company, you want its resources, etc. Right, holding companies, that would be parent company, subsidiary. Okay, and then you've got a note here, friendly versus hostile. Okay, and then you've got the different types here, which is looking at the types of mergers you get. Okay, I have seen questions about this in the past. If you go look at the short multiple choice questions, UNISA has tested this. They've asked you, like they've given you a scenario, and they've asked you which merger or which acquisition is it? Is it horizontal? Is it vertical? Is it congeneric or is it conglomerate? Okay, just have a look at the definitions. The textbooks do describe them in more detail as well. Okay, just think either very big, okay, where you've got massive, so businesses owning everything, okay, kind of like a Bidvest, or you've got horizontal, all right, so mergers of the same kind of business, all right, and then vertical, right, where you're looking at supply chain, okay, like supplier, manufacturer, wholesaler, etc. And then you've got general industry, similar industry, congeneric. Okay, and then the last thing is just strategic. Why would you ever want to do it? It's all about economies of scale, market share, efficiency, and financial. Okay, improving cash flow, cost reductions. Right, it's always strategic. Okay, mergers and acquisitions, very strategic, very theoretical. So I think that's why they haven't asked too many questions about it in your module. Okay. Thank you so much for the opportunity to assist both of you. As I said, I will send out some communication. I will send you that Excel spreadsheet with the lease calculations. And then I'll also just set up time that Saturday before your assessment. I'll be available for an hour if any of you want to meet with me that day just to go through any questions. I don't mind what questions you have. It can be anything. As long as it relates to FIN3701, I'll be happy to answer it for you. All right. Thank you so much for attending. I know it's been long, it's been hectic, but I appreciate your effort and thank you for staying for the full duration.
Thank you.
Thanks, Pressure. Thanks, Damien. You'll get video links for these afterwards, so I will send you communication. Right, enjoy the rest of your weekend. If you're on leave tomorrow, have a nice long weekend.
Thank you, you as well.
Okay. Bye, everyone.
Bye.
Cheers.